Good morning, everyone, and welcome to the TMA Virtual Workshop. My name's Tim Sorrell. I'm a Key Account Manager covering the South. And today on our virtual workshop, we've got sponsors of Kensington, Saffron for Intermediaries, Aldermore, and HSBC Life. So a very good mix of providers from big and small lenders. And also, they're going to be discussing their latest USPs, news, information that's important to you. This morning's session is 2.5 hours, so it's 10 till 12:30. And then we've also got a compliance session as well with our very own Roger Holmes, Senior Specialist Area Supervision Manager. Roger's session has been moved up a notch, so if you did want to see that, please do note of the timings, please. So moving into the agenda, first off, we're going to be having James Burwood from Kensington, followed by Saffron for Intermediaries and Lee Williams. And then we're going to be into a session with Aldermore. Then our compliance session, which was originally scheduled for 12, it is at 11:30 now, so do take note of that. And then we've got HSBC Life and Mark Toms joining us for a protection session. Each provider has got 30 minutes, and the session is being recorded and it will be being played back or available for download in all of our usual places. Before we get started, some housekeeping to be aware of. Please be aware that your cameras and microphones will be off, except for presenters, of course. You can, of course, ask any questions you do have to the presenters. You can do this by utilising our Q&A function. If, for whatever reason, you do have any technical problems, then please do reach out to our broker support team on 0330 303 0236, and they'll be happy to get you back in, happy to get any of those problems resolved for you. CPD certificates will, of course, be available as we're heading towards the end of the year. Topping up valuable CPD hours is, of course, important to all. We will send those CPD certificates to you via the email address which you registered within 2 to 3 working days of the event. There we go. Perfect. Without further ado then, James, I will be your clicker. I'm going to hand it over to you, and I'm going to start the clock and give you your 30 minutes now to discuss with our audience everything that's of a Kensington flavour. Thank you very much. James, over to you.
Awesome. Cheers, Tim. So I'm James. I'm the BDM for sort of most of the East and Essex. So hopefully a lot of you on the call know me already. If not, I'm sure you've already got a relationship with your local BDMs, and hopefully most of this will just be a refresher more than anything. So I'm going to go through some slides. As I say, I'll just be asking Tim to sort of skip through as we go. I'm not going to lie, I don't like some of the slides, so I'll just be skipping them and moving on to the next one. So we might see some stuff and all learn some stuff as well. As Tim said as well, there is a chat box, so if you do have any questions, just pop them in there as we go. And I actually have a question for you guys firstly, as I'm sat here in my slippers. Has anyone put the heating on yet? Just a simple yes or no to get that chat box going. I'm curious. Tim's already shaking his head, so he's not okay with it. I haven't.
Heating not on here, but slippers on like yourself as well, because the floorboards are getting a bit cold.
Totally acceptable to do it yet or not, but right, let's let you guys answer that in the chat, and we'll move through the slide. So Tim, if you can just skip one more as well, please. That's it, perfect. So just a couple of bits I do want to cover off on this slide firstly. So the top bullet point there, up to 95% LTV. So this isn't like special in mortgages or anything. However, in the specialist lending space, it's worth taking a note about. There's only a few lenders at the moment in the specialist lending area that do 95% LTV lending. I believe, off the top of my head, it's us, Aldermore and Precise, I believe. And where we differ slightly from those other two lenders is we do not credit score, we just credit search. So where we can be a really good option is where you've initially tried your 95% with, those high street lenders. It's failing on credit score. It's not quite ticking the box in that respect. We're always a good option in that space, as you'll never get a failed credit score decline with ourselves. So one just worth noting, it's always a good get out of jail free card if you are struggling to support that client. The next bullet point down as well, just worth mentioning. So we do up to 90% loan to value for debt consolidation. So again, there's not too many lenders out there that offer that anymore. And we can basically do it for any legal purpose. including business purposes as well. The only thing we won't do it for is paying a tax bill, okay? In essence, anything else we can consider it. So if you're not sure, obviously speak to myself or your local BDM and we can go through the scenario. We're quite lucky at Kensington in that we have the direct access into underwriters as well. So if it is a little bit quirky or a little bit, in the grey and we're not sure ourselves, we can just pick up the phone, speak to an underwriter directly and get a view to see if it is something that we would consider, even potentially before you do a dip, so you're not wasting time doing dips and FMAs, etc., if it's not going to work. A couple of more bits on this slide just worth mentioning. So new builds, we do up to 90% LTV on new build houses and flats. Now, I would say that's good policy on houses, great policy on flats. There's not many lenders out there that will offer that. So again, it's worth just mentioning that and knowing about it. With shared ownership, we do up to 95% of the share being purchased, and we dabble in some adverse in that space as well. We have recently repriced in this space to make us much more competitive. So I think the goal of the reprice was to make us the cheapest specialist lender when it comes to shared ownership. So hopefully if you do have anything in that space, we should be there or thereabouts the best option now. Right to buy is also on this slide here. Again, one I do just want to touch on. We will do 100% of the discounted purchase price. We'll use the right to buy discount as the deposit. Some lenders do that, some require them to put their own funds into it. Is just one worth knowing about. There's one genuine USP that we have when it comes to right to buy, and this one's definitely worth knowing about, and it's where the right to buy paperwork is in a sole name. We can do it as a joint mortgage, okay? I think we might literally be the only lender that allows it. So yeah, it's definitely one worth remembering. The example I always give is Mrs. has lived in the property for 10 years. She's on the right to buy documentation, but her boyfriend moved in last year, isn't on the documents, but is on the voters roll, paying bills, that kind of thing. It's a legitimate relationship. Absolutely fine. We should be doing that as joint all day long. So yeah, just definitely one worth knowing about. And again, of course, we can support from an adverse perspective in there as well. The only other point I really just want to touch on this slide really is just the bit in that grey box at the bottom there that mentions the low cost of entry product. So across the board, we have no application fees for any of our products, okay? Some of our peer group will charge an application fee. Even if the case is declined, the client doesn't get that back. Whereas with ourselves, you never have to worry about that. In essence, you can get into us for nothing. I believe 90% of the products that we have available at the moment also have free vals. And then on the remo front, we've got lots of like cashback options, fee-assisted legals, that kind of thing as well. So I guess the message I'm trying to get across is that you can get into us and it doesn't cost you or your client anything. Get that manual underwrite approach and see if it is something that we can support with. Tim, if you could just flick on to the next one. I'm not sure if I've got any interest in this one. Oh, yeah, I have. This is a good one, actually. Yeah, brilliant. So self-employed. So this is actually a really big part of what we do at Kensington. So I believe last time I checked, about 40% of the business we get in has an element of self-employed in it. And this is probably the one biggest area of policy where we get business in because of the policy, if that makes sense, irrespective of credit score, adverse, that kind of thing. So there's a couple of bits why. So firstly, we'll always work off the latest year's accounts, okay? So even if there's been a big increase from the previous year to the latest, it could have been 20 grand, 20 grand, 80 grand, we'll use the 80, okay? The key for us is always those last 3 months business bank statements. As long as they're supportive of the turnover required, generally speaking, I've never seen us have an issue with it. There's no loan to value restriction on that either, so we can go right up to that 95% LTV mark and still use that latest year's accounts. And if they're a company director with at least a 50% shareholding, we can use salary and net profit rather than salary and dividends. And we can combine all of those together. So salary and net profit off the latest year at 95% LTV. So when you sort of combine those all together, that's a really juicy bit of policy. One certainly worth knowing about. A couple of other bits on this slide before we move on. We can also consider 1 year's trading. We do cap that one at 85% loan to value. But again, it is an option there if you need us as like a stepping stone lender to then obviously remortgage into a high lender that will accept a 2-year average in the future. And we can also help where there's been a recent change from sole trader to limited company. Again, a lot of lenders will need 1 full year in the current setup, whereas we can in essence do it from day one. So if they've only changed for tax purposes, yeah, we can help straight away in that space as well. Tim, if we could just move on to the next one again, please. Thank you. So contractors, yeah, a couple of bits I do just want to touch on here. So firstly, day rate contractors. If you come across any day rate contractors, we are day rate times 5 times 48. Okay. Again, most lenders are times 46. So it just gives us the extra couple of weeks, which is an extra 10 days of a day rate. And obviously in some cases that day rate is quite a substantial amount. So it can make an overall, quite an overall difference to affordability. So again, one just worth knowing about. Other sorts of contracting, so 0 hours, umbrella, agency, fixed term, nurse bank, CIS contractors, anything like that. Just think 12 months pay slips, treat them as employed, and we'll use 100% of the gross. When it comes to CIS contractors, if you were to look at like the overall sourcing chart, we're probably like fourth. You've got Halifax, who are, in my opinion, quite far ahead. You've got NatWest, who are very good as well. Skipton, I believe, are really solid in that space as well. And then it's probably us. So if you've got anyone that is a CIS contract and has some sort of credit blips, it's probably just the Kensington case. So again, just one worth knowing about. Tim, if you could just move on again, please. Thank you very much. So a couple of bits of other income on here just worth touching on. So overtime bonus, commission, second jobs, we can take up to 100% of those as well. In essence, we're looking at the 3 months pay slips and a P60. And there's a few benefits listed here as well. What I will say is we're not a benefit lender. Okay, so if you've got someone with like DLA, carers allowance, PIP, that kind of thing, it's just not for us. We won't use it. But if you do need just a little top up on your income with like child benefit or quarter maintenance, then absolutely fine. We can add that to the application. Tim, if you could just move on again for me, please. Lovely. So the next 2 slides, these are our income stretch products. So I'm just going to whistle stop tour through these, to be honest, but the hero one is a nice product, is probably how I describe it. As you can see on screen there, it's for emergency services, education, and armed forces. So if you've got someone in one of these roles, then they can qualify for the hero product. It's up to 90% loan to value, and it offers a slight income stretch from our sort of standard 4.5. It goes up to 5 times income. Obviously, the higher the loan to value, the more useful that becomes. There's no sort of minimum incomes or anything like that. And it works that one of the applicants has to qualify, and then the whole application will benefit from the enhanced affordability. So it can be quite useful. And the last point just known about as well is it does come with a very slightly preferential rate. We're talking like 0.1 bips, okay? It's not going to save them thousands of pounds or anything like that. But it's a nice thing to be able to tell your client, when you're looking to sort of seal the deal, you can be like, look, I found your deal. It's with Kensington. It's their hero product because of what you do for a living. And it comes with a slightly preferential rate. So yeah, more a nice thing to be able to tell your client than a life-changing amount of money. If we just flick over to the next one again, please, Tim. So then we've got the professionals product. So this one's a little bit juicier. It offers up to 6 times income. There are some minimum incomes, but generally speaking, in these sort of lines of work, they're pretty irrelevant, really. We can still dabble in some adverse in this space as well. What I will say is the list of roles that are acceptable, that is an exhausted list, okay? So if it's not one of the ones on screen there, we won't treat, they won't be eligible for the professional product. Don't worry about sort of noting it down or remembering them. It is all on the website as well. The main ones we come across is like dentists, doctors, solicitors, that kind of thing. I did have one a couple of months back for a dentist. It was at 90% LTV and we did 5.98 times income. So just sort of a real world example, if that makes sense. So it is doable to get up to those sort of higher income multiples. And the way I talk about this one is you can almost use it like in comparison, like look, Mr. Doctor, you can have a 4.5% rate with X, or you can have a 5.5% rate with Kensington and borrow Y amount. Which way would you prefer to go? So again, just one worth having in your back pocket if you're needing that income stretch. Again, if we could just move on again, please, Tim. On this next slide, a couple of bits just to touch on. There is one other way you can get 6 times income with us, and it is simply if you've got over 100 grand of income on the application. Okay. Again, the system will automatically do that for you then. And the only other bit on this slide I just want to touch on as well is interest only and part. So this is a really big part of what we do. We probably don't talk about it enough, to be honest. I actually think it's a really, really good bit of our policy. So a couple of options here. We have the high earner option, where they earn at least sort of 75 grand a year. They can go right up to 75% LTV on interest only. And you can part to 90 or even 95%, depending on if it's a remortgage or a purchase. We also have a no minimum income option where they can go up to 50% LTV on interest only. And again, you can still part and part to 90-95%. So there's lots of flexibility when it comes to the loan to values. And then probably the best bit of the policy really is if the sale of property is the repayment strategy, we have no minimum equity requirement in the property. Again, I think most lenders nowadays are 250, 300k, whereas we don't have one. It just needs to make sense. So where that's useful is often with the low earner option, the up to 50% LTV option. A lot of people in those properties potentially will never have the equity required for a lot of lenders, whereas it just instantly opens the door for a lender like us to be able to support those clients. Tim, again, if you could just skip the next one as well, if that's okay, please. So just a couple of bits from a credit history and adverse perspective. I'm not going to go through loads in this space. What I would say is if you have got someone with adverse, then please reach out to your BDM, reach out to myself, and we can obviously discuss it. We've got quite a lot of products, so if you're not used to using us, it can look a little bit daunting. So please use your BDM and we can go through the intricacies of the adverse credit and where it fits into our policy. But just a couple of headlines, a couple of key bits really. So if you've got someone that's got the big stuff, bankruptcies, IVAs, as long as they were registered more than 6 years ago, discharged and off the file, we can do it on any of our products. It doesn't matter when it was discharged for us, as long as it is no longer on the file. And then a couple of other sort of smaller bits, if you like. So communications, insurance or bank account defaults, they can be completely ignored, irrelevant of when they were or how much they were for. So they could have defaulted on their Sky bill last month for 500 quid, and we can still look at it on our best sort of cheapest products. And similar to that, if it's a utility default, we do cap it at 250 quid to ignore it, but that is still the case. So gas, electrical, water, up to 250 quid, we'd ignore that as well. If it's over the 250 quid, then it would just need to fit the policy depending on the product. Tim, if you could just move on again for me, please. If you just skip one more again, that's okay. That'd be great. Thank you. So I do want to just spend the rest of my time start really talking about buy-to-let. So a little bit of background. So historically, if we go back 12 months, as a lender, we were probably 90% residential, 10% buy-to-let. Whereas since the turn of the year, if I look at my area in its own, we are now doing 55% buy-to-let, 45% residential, and that's all uplift on the buy-to-let side. We're still doing similar numbers on resi. So there's a reason for it, which is basically what I wanted to tell you about today. So at the back end of last year, we launched a new product called Buy-to-let Prime. Where this is really good is, in essence, it has an element of pay rate lending. Okay, we never used to have that available, so we always were priced quite well. The policy behind it was always quite good, but we didn't have the affordability to support it. Whereas now, in essence, with Buy-to-let Prime, we do. There is a minimum property value attached of 150k, and we don't scale our rates between personal and limited company. Okay, so what that means is, if I'm being completely honest, we're not going to be top of sourcing when it comes to the personally named stuff. However, we are being very aggressive on the limited company side, and we should be in the top 2 or 3 lenders consistently on limited company 5-year deals with our Buy-to-let Prime product. That's including like HMOs and multi-unit blocks as well, so the sort of the more fancy stuff, if that makes sense. So the ICR, in essence, it is for limited company, it's 125% at pay rate or 5%, whichever's higher. So it's nice and simple to work out as well. You don't need to use the long-winded calculator on our website. You should be able to just sort of work out on your calculator, and it makes it nice and simple and a bit easy to do. Again, we have lots of free val products across our limited company range, and even on our HMOs and multi-unit blocks as well, which again can be quite useful when talking to your clients. If we just skip on again there, please, Tim. So a couple of bits on this slide I will just touch on. Firstly, the age one. So at the end of the term, we have no maximum age. Okay, so they could be 80 at the beginning, 120 at the end. That's okay with us. When it comes to the background portfolio, we have absolutely no limit when it comes to the background. Okay, they could have 50 properties, 100 properties, 50 million of lending. That's absolutely fine with us. The only limit we have is 2 million of lending with Kensington. Okay. Also, when we're looking at that background portfolio, we only ever care about the other properties in the entity that you're doing with us. Okay. So what I mean by that is, if you've got someone that's got 10 properties in their personal name and 2 in an SPV, and you're looking to do the third one in that SPV, Those 10 in the personal name, you can completely ignore. You don't need to key them. We don't need packaging for them. You don't need to put them on the portfolio spreadsheet. They will not be stress tested or anything like that. They're just completely ignored. This makes it much easier for you guys to package it, for us to underwrite it. Basically, just means we can be much quicker along the process. And like I said, we don't need like a full business plan or anything like that. It is just the portfolio spreadsheet. Just sidestepping from that as well, actually, we can also do a day one SPV. So someone can set up a new SPV today with a correspondent bank account. We can do a new application in it tomorrow. So again, if you have got a client that's got a bit of a messy portfolio at the moment, maybe they're doing some work to some property, so they're not currently let or something like that, and you don't want us digging around it too much. If the client's happy to, they can technically just set up a new SPV, correspondent bank account, and we can do a new app in it tomorrow. And in essence, everything in that background will be ignored. So again, just one worth knowing about. Just on the right-hand side of the screen here, I'm not sure if this pops up on another slide, but I will just talk about it now, as this is really, really useful. We can also do first-time landlord, first-time buyers, non-residential homeowners, whichever way you want to look at it, within a limited company as well. In essence, we just need it to tick one of the bullet points there if they don't have a minimum salary of 40k. Okay, so if they're a residential homeowner, ignore what I'm about to say. It's absolutely fine. It'll just be done on rental. If they earn at least 40 grand, again, absolutely fine. It will just be done on rental. If they don't tick either of those boxes, we would still be able to do it if they're a non-owner occupier, if they already own a buy-to-let for at least 2 years, already own 4 or more buy-to-lets, or if they live in tied accommodation. So as long as they tick one of those boxes, we can do it even if they're a non-residential homeowner. Tim, if we could just flip on again, please. So obviously I mentioned that limited company, that's like I said, the thing I want to focus on. Our goal for the policy really is to take some of TMW's share. That's sort of our goal with it really. And so far it's been going pretty well. I mentioned TMW because the next point I'm going to mention is sort of a direct sell against, if that makes sense. So they, I believe, still only allow up to 2 directors, whereas we can do up to 4 directors. We do need the directors and shareholders to equal 100% of the company. So at the moment, we can't help where they've got like small percentage shareholders like children on, small percentage shareholders. We can't help in those situations at the moment. So directors and shares do need to match. We can accept deposits from directors' loans or intercompany loans. Again, if it is an intercompany loan, we do just ask that the directors mirror between the trading company and the SPV. Okay, so if it's husband and wife, absolutely fine. If it's husband and mate, husband and wife, not okay. We wouldn't be able to. It would have to be our director's loan. A couple of bits that we don't do, just so you are aware as well, we don't do any sort of trading companies. We don't do any LLPs, any sort of complex lease structures, any layered companies, anything like that we don't do. So like I say, we're looking for that sort of cleaner cut buy-to-let business when it comes to this specific product. Again, if we can just flick on one more, Tim, please. I'm just checking off, just making sure. I believe I've sort of covered off all of that already. Yeah, one more, please. That's okay, Tim. So if we just move on here to the HMOs and multi-unit blocks, again, it's the simple stuff. So we're up to 6 rooms or 6 units respectively. And like I say, we do a free vow products in this space as well, which again is often really, really useful. The only bit I really want to highlight here again is that we can accept first-time landlords in this space as well, as long as there is a combined income of 75k on the application. Sounds like a big number, but if you've got 4 directors, it's like, what is it, 18 grand each, something like that. So it's not too bad when you sort of break it down. So yeah, there's not loads to tell you about on that one. All I would say is we're pricing very competitively. And yeah, we can do up to 6 rooms or 6 units. If we just skip a couple more slides, Tim, if that's okay. So it should be your support, the next one. Yeah, brilliant. So this is sort of the last one I just want to touch on really. So obviously, for those of you that are, in my patch, you've got myself, call, email, text, WhatsApp, whatever works for you guys. For anyone else, if you don't know who your BDM is, please come to me and I can direct you. Or there is a useful tool on the website where you just put in your postcode and it tells you who your local BDM is, comes up with their email address, their phone number, etc. What I would say is if it's policy related, I think I can speak on behalf of all the BDMs that we will want you to call us and speak to us about it. We do have the BDMs in the office that were great, and they are really good with policy, and they pick up the phone consistently within a few minutes. I think the average this week is like 2.5 minutes, so you're never waiting too long. So if you can't get hold of us, of course, they are a great option. Vice versa, if you need help with systems, so like calculators, DIPs, FMAs, that kind of thing, don't call me. I won't know the answer. However, The guys in the office are brilliant with the system stuff. Like I say, they pick up the phone quickly and they'll have you on your way nice and quickly as well. So please do just reach out and use those guys. And then just from an underwrite perspective, so we're assessing new business applications within 3 days at the moment, which again gives you a little bit of time to get your sort of initial documentation in. All further information is being picked up within 1 day, so within 24 hours. And our average speed to offer across the board is 13 days. So generally speaking, we're pretty quick across the board. Where we can be really useful as well is we do have lots of different routes into us. So let's say we have direct access into the underwriters as BDMs. You guys can also speak directly to the underwriters as well, which is a massive benefit, especially for me, because it means you don't need to call me about this stuff. You can call the underwriter directly. And they should be contacting you at their initial underwrite as well. So they can, hopefully you can deal with any queries there. If, of course, you haven't had a call or you've not been able to get hold of each other, come to me and I can get that arranged with you as well. I've even done it a couple of times where it's really complex, where I've jumped on like a Teams call with the broker and the underwriter and we've sort of hashed it out all together and had some really good results that way as well. So I guess what I'm saying is there's nothing off the table when it comes to communication with us. Just reach out and we'll do everything we possibly can. Obviously in specialist lending, sometimes things go wrong. So I think it's always best to have that conversation directly with the mandate holder. Of course, if we're not getting what we want, I do also have routes into like underwriting managers and escalations and stuff like that. So we can look down that route as well. From myself, what I would say is I am quite direct. So if I can help, I will tell you, I will try my best and I will do it. But at the same time, if I think we're just wasting our time, I'll tell you straight away. I'm not one of them BDMs that will waste 2 weeks of yours and your client's time just to get the exact same result. If I can't help, I'll tell you. I'd rather you hate me for 10 minutes than hate me for 2 weeks. So I think I've got a couple of minutes left, Tim, but that is everything I wanted to cover, to be honest. So unless there's any questions that have come through.
There has been one question drop in, which I'll get to in just a second. Please, if you have got a question, do type it up and put it in the Q&A section, please, and I'll get to it in just a second. But James, just want to say thanks very much for that. That was really sort of intuitive, really insightful. I've certainly picked up a few great bits from there. So using the latest accounts and just having 3 months business bank statements all the way up to 95%, that's a big one. I know a lot of brokers are going to be really sort of happy with that, as well as the 1 year trading history as well, up to 85%. So, a lot of clients that see brokers are of course self-employed and they're always looking for ways just to get that extra bit of borrowing. So great bits of policy. Also surprised to learn about that no minimum equity on the interest only you mentioned as well. So really good.
Yeah,
really, really good bit. And I suppose from TMA perspective, we too are seeing sort of quite a big growth in buy-to-let figures. So, pleasing to sort of see that you two are seeing that as well. Okay, so let's get to some of the questions then, because we've got a couple of minutes before we move on. First question from Caroline. Do you allow company lets, e.g. council or housing association or one of the registered landlords?
Oh, good question. Yeah, that was one of the things I was meant to mention in the bit where I said, funnily enough. So yeah, the simple answer is no, we don't do anything like that at the moment. This new push, if you like, into limit company buy-to-let is still quite fresh. So what I would say is nothing's off the table in the future. There's lots of conversation going on in the background, but yeah, as it stands today, no, the AST would have to be in a personal name, individual name.
Perfect. Thanks very much. And the next one was from Manda. With right to buy, is that joint borrower sole proprietor and can it work with mother and a son?
Oh, great question again. So it's not JBSP. So they will both be on the mortgage, both be on the deeds. I believe there is a lender out there that does it JBSP. So there is an option out there in that respect. I think we're the only people that do it the way we do it, if that makes sense. And absolutely, it could be a mother-son situation. All I would say is we will always go off the oldest applicant's age, irrespective of if we need their income or anything like that. So just bear that in mind when we are looking at if it's a mother-son option that may restrict the term. And I don't know if anyone has asked it, but we don't do it the other way. So we won't do it where the paperwork's in joint name. We can't do the mortgage in a sole name. I often get asked that as well.
Okay, thanks very much. Aftab has raised a hand. Unfortunately, we can't mute you because you are in listen only. Is it possible you could input your question into the Q&A, please, if that's all right, and we can pick up, or I can certainly sort of come back to you with James's assistance after today.
Absolutely, yeah.
So I'll give Aftab just a moment just to type it in if possible. Otherwise, we will sort of have to circle back to it. Okay, James, thanks very much. Oh, here we go. It's just landed. Right to acquire. So right to acquire, i.e. from housing association. Is that going to be something that's possible, please, James?
Not something we do, no. It's an interesting one for me because it's very similar to right to buy, isn't it? I think it's something to do with the legalities, but yeah, short answer, we don't do right to acquire. We do right to buy, we don't do right to acquire.
Okay. Well, thanks very much. Really appreciate that. That was a really great session. Thanks very much, James. I'm now going to be moving on to our next bit. So without further ado, Lee Williams, welcome on board. Let's hear what you've got to say about Saffron for intermediaries and all things Saffron, please. Yeah, I'm happy to move your slides on it as well. So let me know when you want to move them. But yeah, looking forward to hearing what's going on in Saffron, if that's okay.
Oh, thank you very much. And yeah, thanks, Tim, and thanks everyone for joining. I appreciate everyone's really busy. So yeah, obviously there's been quite a lot, if I'm honest with you, Tim, in terms of what's been going on with Saffron for intermediaries. We've had a huge amount of policy changes that has been very well timed for today's webinar. So I do appreciate that. So there's loads for us to run through. One thing I would say is that Laura was going to be presenting, so I appreciate you changing this for me quickly, and I hope she's feeling a bit better shortly. So yeah, I'm National Sales Manager at Saffron for Intermediaries. I look after the BDM team, and yeah, I will end with their details so that you can obviously pick up with them as well, because we are really keen to work with you. Like James said, there's going to be some slides that are more interesting than others, I'm not going to lie. So we will move through those. And to answer James's question, no, my heating isn't on. I'm way too tight, and I haven't got any slippers because I'm in the office and I'd already get bad looks as it is. So let's move on to Saffron. So we talk about embracing different, and the reason we talk about embracing different is we want to be seen as the lender that you would go to when the high street says no. So there's normally something that's a bit different about that case that means that the high street is not ticking the box, and therefore we're not able to help. So in terms of ourselves, a little bit here in terms of our history, we've been going for some time, but ultimately we're one of those lenders that our approach is to work with you, understand a case holistically, and not need every box to be ticked. Okay, I'm going to explain how that would work in a moment. So Tim, if you move on a moment, it will go through a little bit in terms of our key areas that we look at. I'm going to cover some of those today. Okay, so next slide, please. So we'll start with the journey based on first-time buyers. So a lot of the stuff that I'm going to run through today are eligible for first-time buyers. But what I wanted to do, and what Laura wanted to do when we're putting this together, was to highlight what are we actually really finding that we're busy in at the moment. So obviously affordability being one that we're going to cover, but the other being deposit. So if we move on a moment, what it will do is it's just going to highlight some of the ways that we can support. So for first-time buyers, we can go up to 95%. That includes new build houses. But the big thing that we're finding is deposit. Okay, so being able to take a 5% incentive from a builder when it comes to a new build, being able to use personal loan as deposit. That's something we can obviously consider. In that scenario, I always give a caveat that we're looking for the right customer. So in that sense, it's someone who has got good banking conduct, good customers. They just ultimately can't get there soon enough. They want to buy now. They don't want to buy in a year's time. So ultimately, being able to take a loan, it fits affordability, we can then consider it. We're also seeing a lot of concessionary purchases, whether that be from family members or landlords. So we can accept a concessionary purchase where the concession is effectively treated as gifted equity. And in that scenario, we don't need any other sources of deposits if it already fits the LTV thresholds. So I know other lenders may ask for certain 5% or whatever when it comes to a concessionary purchase from other means. We don't need that. So ultimately, we can consider it based on that gifted equity. And that's really helping when it comes to our first-time buyers. Next slide, please. So I said deposit's been one, affordability's been another. Our joint borrower sole proprietor previously has been all about first-time buyers. We have now opened that up so that it's now for home movers and for remortgages, because we're finding such a need for this. Now, there are plenty, like James said, that go in the market when it comes to joint borrower sole proprietor. What our USP is term. What we will do is we'll base the term on the owner occupiers rather than the support. So you could have son and partner buying a property and they want support from father and mother, for example. As long as father and mother is under the age of 70 at application, we will base the term on the owner occupiers, freeing up the fact that hopefully that means that they therefore don't need as much support because we're allowing them that longer term to spread the payments over. Now, the reason we can do that is we limit the amount of support the supporters can give. So effectively, they can support up to 30% of the loan. They need to be able to cover at least themselves 70%. And then ultimately what that would do is it would allow them to have that term with our view that in 5 to 10 years time, they're not going to need that support. So therefore we've helped them get on the market. And in this case now, move home or remortgage so that they can obviously own that in their own rights. Okay. This has been a really big update for us. We've been extremely busy when it comes to first-time buyers for these customers, but now being able to do it for home movers and remortgages, it's what you've been asking for. So it's just great to be able to say that we now have this available. Next slide on will actually just give an example of this. So I apologize, it's a bit stretched, but it's a first-time buyer. Effectively, there were 69, the father was 69, supporting family, and then we were able to do it over a 40-year term. Okay, and we've highlighted in this journey that what really helped the overall journey was working with your BDM. Okay, and actually in this scenario, Leah, who looks after our Midlands North region, was able to work directly with the underwriters really quickly in this case to be able to help because there were some really tight deadlines on it as well. Move on, next slide, please. So we can't embrace different if we don't talk about the fact that we're willing to accept some complex incomes, okay? And as a lender who wants to do large loans, which we'll talk about in a moment, we very much do embrace those complex incomes where it doesn't quite fit the norm. So next slide, please. I'll start with self-employed, I believe. There we go. So when it comes to self-employed, we want at least 1 year's trading, okay? What we will do is we have no cap on the increase as well. So you might have gone from 10K to 150K. The thing that's different with us compared to many other lenders is that we won't ask for business bank statements as standard. What we do is we get an accountant's reference and we look for the projection to show that they're on the track to continue at that higher level. So as long as we've got that projection, we will go off that larger, the most recent year in that scenario. Now, if it's been an uplift of up to 25%, we can go on our standard range. Anything more than 25% or just 1 year's trading, then we would then look on our normal our more specialist self-employed products. Just so that obviously we can then use that extra flexibility that we're looking to use when it comes to assessing their income. We can use share of profits as long as they've got at least a 50% ownership in the business. But like I just said, the key thing for us is that we want to get to know the business. We want to look at the accountant's projection in that scenario. We don't have any minimum amount of time that they've gone from sole trader to limited company. It could have happened yesterday. As long as there's no real operational changes to the business, then we are happy to go off that. We'll normally get something from the accountant to say that it's going to continue as normal, and we can therefore use their income that we would have done through their SA 302s and their tax year overviews. Okay, but we're seeing a huge uplift in this area, just because obviously the way that we can look at the incomes. And then when I go into our large loan proposition, you can see how much of a benefit that can make. Next slide, please. So here's an example of a customer who needed 90%, £1 million purchase. So we can go up to £1 million lending at 90%. We can go up to 5 million at 80%. So in this scenario, they needed to use a mixture of incomes as well as, in this scenario, a drop in income, which was what was causing the issue. And there was that drop in the self-employed income as well as their contractor income. We were able to use a mixture of the incomes. We got an accountant's reference to confirm that the income wasn't likely to drop any further, and we're happy to go on the most recent year. So as much as I talk about positives where we've been able to look at the most recent year because of the fact that there's been uplifts, actually we've been able to support customers where they might have had a drop for particular reasons, they're one-offs. We do a lot in the area where customers have been on maternity leave, and the most recent year is lower, but they're back. They're projected to continue at the level they were previously at. And what we can do in that scenario is look to ignore the most recent year. So there's a lot of flexibility that we can do with our self-employed proposition. So I just thought I'd give a couple of examples, so just try and bring it to life, really. Next slide, please. So contractors, like James said, we can also do 48. Key thing for us is we will look at experience. We'll look at experience. So it might be that you've got somebody who's been contracting for a while. Great. If they've got at least, but what we look for is 2 years of working, 3 months in contracting. But it can sometimes be that they've been in the same industry, the same line of work for at least a year, and we can then look at contracting after just 1 month. Go off the contract, have 1 month pay slip, 1 month bank statement. We can do that off the contract. We could do umbrella, go off the gross based on what they actually receive after the umbrella deduction, if there is any, or if they own their own umbrella company, so they're the limited company and it's contracted to that limited company, then we can go off the gross figure that effectively the business receives, because they are the business. CIS has been a massive area for us because we just look now for 3 months of experience, for 3 months pay slips, and 1 year in the industry. So ultimately, from that point of view, we can look at it after 3 months. Now, if you've got 3 months where they've been continually working, not taking a minute off, we're going to annualize that over 48 weeks. What we have found recently, especially with the summer holidays, is that people take holiday, which is lovely. But then that impacts affordability when you're trying to do averages. So what we can do, if we can see that they've had at least 2 weeks within that 13 weeks as holiday, we can look to annualize that over 52 weeks, because ultimately we're annualizing that holiday at the same time. Okay, so there's a lot of extra flexibility. If you're taking one thing away from us, or hopefully more than one, but one thing would be, please get in touch and let's talk through these scenarios, because ultimately there's a lot that we can do to work with you and the way that we work with our underwriters. I'm not going to read this slide, but you can see there's more that we can do. Multiple incomes, we can do gaps in contracting. There's a lot that we can do to help with those cases, which tend to be quite affluent customers, good incomes. It's just being able to be that flexible approach to actually consider it the way that they need it. So if I move on, next slide, please. So here's an example of a CIS contractor where we've done exactly that. We would normally say that we would, most lenders would be 46 or 48 annualization, or even treat them as self-employed. In our scenario, we were able to annualize it over 52 weeks. We had that holiday period, and obviously we've been able to help that customer. So again, on our website, we've actually got case studies which bring these scenarios to life. So obviously that's a useful link if you want that as well. Next slide, please. Foster care income, recent enhancement for us. So we just look for 12 months of track record, and we look at the last 3 months remittance slips and annualize that over 52 weeks. So quite straightforward. It's an area that we've recently moved into. We found that it wasn't as served as well. So ultimately we've looked at where can we help. So it's quite straightforward, but ultimately customers that have got foster care income, the high street saying no for whatever reason, then it is worth considering us to try and help with that affordability. Next slide, please. Sorry, I'm going at a pace on some of these just because there's some really exciting bits. So this is the bit that I'm really excited about, because this is really like a real recent enhancement, like literally within days. So we have changed our affordability model. So basically, we know that's one of the biggest challenges in the market today. I don't need to tell you that. So what we've looked at, like many other lenders, is what can we do when it comes to our loan to income ratios? And I'm really pleased to say that we've made a massive change. So I'll move on to the next slide. Hopefully, there we go. It will show some basic stuff to start off with. So what we've done is we were always 4.49, or we might be able to go up to 5 times income if they had a 50,000 sole income or an 80,000 joint. Now we've really changed it. So if you've got a first-time buyer, you've got a normal owner-occupied range, or even self-build, we can now, if they've got a joint income of 80,000 or a sole income of 50,000, we can look to as standard go up to 5.5 times income when it's below 85%. Okay, so really helping affordability for those customers in those areas where ultimately they might not be getting enough. We can obviously help with that now. Okay, we move on to the next slide. An even more exciting update is that we've got some areas where we have no loan to income caps at all. So this is where we're in the large loan space for us, which is £1 million plus. Ultimately, we've got that with our residential and also our self-build. And now we can look at it where we're just purely basing it on affordability if they have a sole or joint income of 150,000, which, bearing in mind the loan size, we would expect they're going to have that income or anyway. So what that does, it enables us to help those customers when it comes to obviously stretching their affordability, not being capped by the income multiples when we know that it's affordable. Okay, and as you can see, we can go up to residential at 80% in that scenario, and on our self-build, we can look up to 75%. So some really good updates from us to try and help with the headaches that I'm sure you've got when it comes to your customers' affordability at times. And we've made some real decent enhancements to our calculators, which I know one of the calculators will be, well, all of the calculators will be live on Thursday, so that you can see these enhanced updates. If it's before Thursday, then we're here to work with you if you're not getting that figure that you're looking for. But I'm just making sure you've got these updates hot off the press, really. Next slide, please. So we then also have our professional income boost. I know many other lenders out there do. One thing that's different with ours, so if we move on to the next slide, we've made some recent changes. One, looking at eligibility. So now they just need to be qualified within the last 10 years within a selective range of professions, which we've now added a lot, such as mortgage brokers, financial advisors. We've got a big long list, so please do check that out. But you are on there, okay? We have also now added self-employed. So this was an area that we are getting a lot of questions around, and literally in the last few days we've added self-employed where they've got at least 2 years track record of being self-employed. In this scenario where they're qualified within the last 10 years, they would then be eligible to go up to 6 times income under this professional income boost product. So again, we know the headaches for affordability. We've looked at how can we try and address that and support your customers. Next slide, please. So later life and interest only. Obviously, for many, we've already talked about the need for interest only in the market for the right customers. So next slide, hopefully will show a little bit more in terms of how we can help with that. So if we're looking at, first of all, later life, now for us, that means RIO. So obviously you want an open-ended. We can obviously look at RIO with no minimum income. We go up to 60% loan to value, and we have no minimum equity requirement when it comes to our RIO product. What we also then have is our lending into retirement downsizing product. What that is effectively a product with a term. So what we do is we use ONS data to look at the term that we can consider. Where this can benefit customers is when it doesn't fit on a RIO. So we see a lot of the times where you're looking at a RIO, it's a joint case, we're trying to do affordability on the lowest surviving income, doesn't fit, and therefore you want to still extend the term. Now, if it's a case that you're still using pensions or passive incomes, such as property income, we can do that on our lending into retirement downsizing product, up to 60% loan to value. And in that scenario, we would need 250 equity on application. Now, that's great in retirement. When it's not retirement, if we move on to the next slide, please, I hope. It will, no, it has not got it on there, so I will move on very quickly to the interest only a bit. But just very quickly, if it's just purely interest only, we will go up to 70% loan to value. We have no minimum incomes if it's not in retirement. as well, no minimum incomes. We stress test on interest only. So again, that can help with affordability. If it's sale and downsize, we do look to 250 equity as standard. However, if they're in an area where they genuinely can downsize for less, we do have flexibility to consider less. And we can use earned income up to 75 years old. So as long as it's plausible, feasible to do so, then we can look at that as well. Sorry, next slide. I was wrong before, I was jumping the gun. And then in terms of buy-to-lets, there we go. Well, you said this is the biggest growth area, so I got there a bit quicker. There we go. So it's been very busy for us. One, we've been really competitively priced over the last few weeks, which has obviously helped, but also our policy. So next slide, please. What we can do is we can look at personal name ownership. We can look at limited company. We can have up to 4 people on an application. If it's a limited company, we'd have up to 4 shareholders, 4 directors. Okay. All would need to be named on the application. So the same as Kensington, we wouldn't be looking at applications where you've got minority shareholders for children. That's not something we can consider as yet. We would need all to be named on the application. Now, the reasons that we've been busy that I just mentioned is portfolios. We have no cap on how many properties you can own elsewhere. You can have up to 10 with us with a cumulative lend of £3 million. Now, I'll be honest, I think there's some flex on that. So if you've got a customer who's already got that, great, let's have a chat. But that would be our standard policy. We can look at that in limited company and personal name. We then also do expat, very much known for expat because we have a long list of countries we can deal with and a very, very small list of countries that we're not able to consider them residing in. So it's sanction list countries in the main that we're not able to consider. So we're doing a lot of expat buy-to-lets. The other reason that we're busy is our stress testing. We can look at if it's a pound for pound remortgage, 125 at pay rate, irrespective of tax position. Okay, and that can be a personal name ownership and limited company. So pound for pound remortgage we can support. We could also help when it comes to top slicing. So if it's not quite getting there, we can look to get to 100%, 110% coverage on the rental by adding in their personal income as long as they earn at least 75,000. And that's the same for expats. As long as it's the equivalent of 75,000, then they are eligible for us to look at that top slicing to help. But having no differential for higher rate taxpayers really, really supports. And if you've got those pound for pound remortgages, we're really, really able to obviously help when it comes to the affordability at 125 at pay rate. And that also includes our 2-year discount. So if you sat there with a customer, they don't want to be tied in for 5 years, it's impacting their affordability. It's well worth thinking about Saffron because we can look at it on our 2-year discount products as well at that pay rate if it's a pound for pound remortgage. Okay, moving on slightly. A couple of other areas of criteria. Just want to quickly mention while I've got you. When it comes to buy-to-lets, we've also been really busy when it comes to our visa policy because we can consider the 5 main types of visas: global talent, skilled workers, so the old tier 2 visas, at 75% with no minimum income, which really helps our buy-to-let proposition. But what we'd also then look at is going beyond 75% for residential with a minimum income of 75,000. So again, we're able to help those as well. We monetize investments. So if you've got a pension pot where they're eligible to draw down on it, we can support those customers by taking a 30% haircut off the remaining 70%. We divide by the mortgage term, and then there's a salary that we can consider. Same thing with the investment pots, but we take a 40% haircut. The remaining 60% is divided by the mortgage term, again, supporting affordability. So I think it's pretty obvious that they're the key areas that we've been working on when it comes to where we can improve our proposition, and then supporting those customers that need those larger loans where we have a number of different tiered products to support those customers. Moving on, because I know that we're short for time. Just very quickly. Oh, there we go. Jump the gun on interest only. Me and Laura clearly have a different style. I would have brought that in a little bit earlier, but there we go. And then next slide, please. I believe is a bit about self-build. So just 1 minute on self-build. If you've not done self-build, it's a growing market. You've got direct option to use us directly, or going for a packager, whatever works best for you, but you do have that option directly. And what we found has been really useful is the fact that if you're doing self-build, you're used to the ground up developments, yes, brilliant. But what it can also be used for is those renovations, conversions. So what that also means is properties where a value has gone out, deemed it uninhabitable, actually won't take a huge amount of work. I mean, a scenario that I've had recently is where a thatch needed to be replaced. You know, we can then consider that on the self-build. We want to be involved in the works that they need to get completed, and therefore, you know, what might be deemed as a regulated bridge that you might be considering, actually we can look at it on a self-build based on a long-term mortgage for them, therefore not needing an exit. We've got a number of products with no early repayment charges, which can also help. So we've got a good suite of self-build products that we can work with you, and we've put on their renovation mortgages just to really open up that part of the market as well, which won't automatically be thought of as self-build, but that's where we can help. And then next slide, I believe, I will move on because I gave a scenario already. Next slide, please, is basically just our details. If you're not registered, please do. I can't tell you about our updates if you're not registered. So there's a benefit straight away. And then hopefully if you're registered, we're going to be able to work with you, with the team that you've now got on the screen, to be able to place your cases. Okay. So you can see the details of my team. I've got a new BDM joining next month as well. Sorry, I thought we were a bit further into the year. November, they're joining me, which is great. And then we've also got our intermediary support team, which is our telephone team as well. So we're all really keen to work with you, not just purely work on cases you've got on the desks, which ultimately we do want to help with, but also is there some opportunities that we can work with you to develop new opportunities for business as well. But thank you for listening. I appreciate your time.
Perfect. Thanks very much, Lee. And look, I really, really appreciate you jumping in for Laura. You did a sterling job.
Thank you.
And she had to sort of moved around some of the slides. So really, really appreciate you picking up that. That was really sort of comprehensive. And we have got a few questions asked, so I will get around to them in just a sec. But certainly, again, just a few of the highlights from me. That personal owner's deposit, really, really good. Joint borrower sole proprietor. You know, that example you mentioned, that was 69, you were still able to give a 40-year term. I know that pops up time and time again. So to have sort of lenders in that space is really, really good. Certainly, you know, CIS, that seems like you're probably going to be sweeping up quite a lot of business with a policy that just uses that 1 year's industry experience. That must be a sort of really, really sort of good bit of business that you, of course, get. So yeah, that's really, really good. And certainly the move into foster care, you are 100% right. I mean, thinking about it, I do massively believe it's a big underserved segment of the market. So moving into that really does you know, offer some really, really good solutions there. So that's perfect. And you know, a bit of friendly competition, you know, James at the Kensington set the bar quite high when he mentioned self-employed 1 year's trading figures. You've come along and said, we can do that. And we don't need those business bank statements. We just need, obviously, that accountant's reference or projection. So good little bit of sparring. I'm hoping to see what, you know, if Aldermore can increase that later on, but we'll get to that in a minute. So let's have a look at some of the questions. Where has it gone? They've just popped off my screen. So Manda asked a question on concessionary. I would imagine concessionary purchase. What is the LTV? I think you covered that, wasn't it? 100% of the discount purchase price.
Yeah, so basically, if they're first time buyer, we can go up to 95%. So if it's a case that covers the 5%, great. But basically, the concession can cover the loan to value threshold. We don't need it to be other sources. Now, if it's a concessionary purchase where it's from a landlord and they're giving an astronomical amount, then ultimately what we would need to consider is why. And that's where, you know, some backstory, understanding what's happened is really, really key. So 5% is standard, absolutely. But ultimately, if it's a case that they've got more, then please talk to us.
Perfect, lovely. Next question was picking up on that key point of joint borrower sole proprietor. Amanda's asked us another question, which is JBSP. What is the LTV? So can you just run through a different couple of scenarios there?
Sorry, which scenario was that? Sorry.
LTV on JBSP, please. Is there sort of specific loan to values you do on that?
Yeah, absolutely. Sorry. So yes, we can go up to 95% for first time buyers. And that also includes new build houses. And then it would then be 90% that we can consider for home movers and remortgages.
Okay, perfect. Thank you very much. And then the last question, I believe, is from Caroline. And she said, Lee, you mentioned a client can have a personal loan for a deposit subject to affordability. Can a landlord or family selling a property give a part deposit, part loan, e.g. 15% price reduction and half is a gift and half is a loan?
In all honesty, it's family. Landlords is a challenging one for us to get behind in that sense. But from a family member, yes, absolutely. They could be, rather than just gifting, they might be giving a loan. And therefore, we would look to include that within the affordability. What we wouldn't do is allow that to be a second charge, though. Okay, so it would have to be an unsecured loan in that scenario. And then that's when we can then consider it.
And any loan that's given would need to be sort of factored into affordability, yeah?
Absolutely. If they're making a monthly payment, then we need to factor that in. So yeah, whatever payment there is, whatever rationale, even if it's annual, we need to monthly consider that.
Okay, well, that was it. Oh, one other question has just popped in. Oh no, it's just that. Thanks very much.
Oh, brilliant. Excellent. Thank you.
Brilliant. Well, look, James, sorry, Lee, really appreciate you popping in.
Oh, thank you.
Noticed and covering Laura. Really, really good of you. We're now going to move on. Thank you very much. Okay, and our next provider lender is going to be Aldermore and the wonderful Kelsey. Kelsey, are you there?
Morning. I am here, Tim.
Perfect. Brilliant. Welcome to our virtual workshop. I'm looking forward to seeing what you've got. So, shall we move
Fabulous. Yeah, thanks. Can I just say before I start, apologies if you have any interference with internet. It seems to be, for some reason, it always happens when I'm on webinars as well. There's an issue, so apologies before then. So, morning everyone. My name is Kelsey Edge and I'm one of the National Account Managers for Aldermore that's responsible for the TMA webinar. Tim, do you want to move on to the next screen?
Sure.
So I'm here today to talk to you about all Aldermore can help you with for you and your customers. Now, we've worked extremely hard over the last few years to develop our proposition, and that proposition is there to support more customers who are first-time buyers, those with credit issues, the self-employed, and of course buy-to-let. So probably most of you, if you have used us, it would be on buy-to-let. We probably get, I know that James mentioned about the change around their types of business over the last year. We used to be a lot of residential. Now we've moved more so on buy-to-let. So probably around 75% of our business currently is buy-to-let. We are not here to compete against the high street lenders. We're here to support underserved customers who need that manual underwrite and a helping hand to get onto the property market. Next screen, please, Tim.
Sure.
So where are we going to be able to help? So what I thought I'd do initially is just give you a bit of a brief overview of those proposition changes that we've recently made. I'm not going to go through everything on that screen, but I'm just going to pick out the most recent. So Day one remortgages. This is for buy-to-let. So we're finding a lot of our landlords are now looking at going to auctions or buying properties in cash. They then, of course, refurbing those particular properties and then wanting to draw that money back out of those particular properties. And we can do that now. Now, we've always been able.
Oh, we have just lost you, Kelsey.
Oh.
Okay, just
Sorry,
repeat that last sort of 10 seconds worth, please.
Oh, apologies.
That's right.
Yeah, so we used to always do day one remortgages, but it was always based on purchase price, and now it's based on open market value. So like I say, that could be a landlord going to auction, buying at cash, or even taking a bridging loan and then wanting to refinance that bridging loan. We can do that within a 6 months period. The other two items I want to just highlight as well, a concessionary purchase. I know Lee just mentioned that as well from the Saffron. We have recently introduced concessionary purchase for family members. So, for example, I could be living in mum and dad's house. It's worth 100,000. They've said to me, you can buy it off us for 50,000. We would then lend, as Aldermore would lend, 50,000 in that instance. Landlord tenant equity discount we've also introduced. Now this is with a minimum of 5% deposit. So this is where you'll have maybe your first time buyers that want to buy off those particular landlords, or if you're seeing those landlords selling off those properties, we can do it in this instance, and that tenant doesn't necessarily have to have a deposit. Now we can go up to a maximum of 25% on that, and this is for residential only. So this is not a landlord selling to another landlord. It would be a landlord potentially selling to a first-time buyer who doesn't have the discount, who doesn't have the deposit, but can actually then get on the property ladder. Another couple of items I just want to touch on as well. From a residential point of view, we've increased some of our loan sizes. So we can now do a maximum loan up to £1 million, and that is up to 95% LTV. We've also increased our age up to 75% and also reduced our minimum valuations from 60,000 to 50,000. Tim, do you want to move on to the next screen, please? So how can we help in those residential spaces for those customers? As a specialist lender, we do go up to 95%. I mean, I know James mentioned there's only a few of us, which Kensington being one, and Precise. We can accept family gifts, although we do 95%, we can accept a full family gift. So that can come from, understandably, your mum, dad. We can also extend that out to aunt and uncle. And also, as part of those product ranges, we do offer things like free valuations and free options for solicitors as well. From an affordability piece as well, so just helping out those first-time buyers, we can not only take 100% of their main job, but we can on second jobs as well. So we do expect somebody to be in a second job between 3 to 6 months to give some consistency with that. We can also take into account benefits as well. So we can look at 100% of working tax credit, we can look at universal credit, we can use working tax, and we can use child tax. The only benefit that we don't take into consideration would be child tax credit, but that is incorporated into our affordability already. As part of our affordability as well, we've always been a lender whereby we've lent up to 5.5 times. Now that is irrelevant of your profession, so you don't have to be a full person, and also irrelevant of loan to value as well. So it's not capped at, say, 75%. So in essence, you could have a first-time buyer that has a minimum of 5% deposit. They need to incorporate either 2 jobs, or they need to incorporate a main income plus any working tax credits, and they're wanting to go up to 95%. Income-wise, if all that income or the joint income for the household exceeds 60,000, it pushes it up into our threshold of up to 5.5 times. So anything under 60, and this is household income, so it could be an application made in a sole name or an application that's joint. And as I've mentioned, all the incomes that we can include in that will push it into that 60,000 category. We hopefully can look to extend that up to a 5.5 times income multiplier. Under 60,000, you're looking at up to 4.5 times. Other items as well that we've introduced to help out on affordability, and one that you may not be aware of, is that we've got some products out there which have a discounted reversionary rate. And of course, because of that, that will help out on the affordability piece. Now, I know a lot of you would look at probably switching from maybe a 2-year to a 5-year for affordability. In this instance, this discounted reversionary rate product is actually a 2-year. So it's certainly worth looking at if you've, for example, completed a DIP with ourselves, is slightly short on affordability. There could be that option of looking at that slightly different product to actually get the affordability for the customers. Tim, can you move on, please, lovely? So residential wise, as I mentioned, we do 75%. I also mentioned that we've worked hard over the last few years around our proposition as well. And one type of that proposition that we've changed is literally our adverse. Now, we've always had a level 3, so we introduce a level 1, 2 and 3 across our range. probably you're going back to last year now, we made changes to that. We understood that really it wasn't fit for the market, and especially with the changes, the cost of living, etc., and that people were experiencing. So we now have level 3s. Level 1 starts at 95%, our level 2 and our level 3 is at 80%. Tim, do you want to move on to the next screen, and I can show you what that looks like. So I'm not going to go into great detail about this. I will send this out to everybody. And I think, Tim, will everybody have these presentations sent on to them?
Absolutely, yes. A copy of the whole video presentation, including the slides, will of course be made available after this. So you've obviously got the presenter's commentary running alongside the slides that really sort of brings it home.
Fabulous. Thank you for that. So yeah, the things that I want to point out is just, as I say, with the changes that we've made to our level 1, 2 and 3, up to 95%, we are looking in the main for the larger defaults and CCJs still to be over 3 years. Now with ourselves, the change that we made is that defaults and CCJs do not need to be satisfied across everything, our whole range. We have introduced whereby, however, customers can have small defaults and CCJs that are valued up to £300 per applicant. So I'll give you an example of a customer that we've helped out, and this is at 95%. They were first-time buyers, they'd gone to High Street. Unfortunately, their credit profile was lacking. Now we were able to help because on there they had communication default for £70 for Vodafone, and that was registered 18 months ago. But they also had a parking fine for £80 as a CCJ, and that was registered 12 months ago. Now, looking across that, so you're talking about somebody who's got adverse, one of them in the last 12 months in that instance, we were still able to help because we can look at ignoring CCJs and defaults of a combined amount up to £300 as part of our application process. So that was up to 95%. Now, if you also are seeing customers that have had more recent, if I jump to our level 3, which is up to 80%, we can look at customers that have may had CCJs and defaults that were registered over 6 months ago. So if you are coming across that customer, now in that instance, what we're looking for from a customer is that there's been a reason for it. If we're looking at a customer's profile and that for every year over the last 3 years, there's been consistent missed payments, default CCJs registered, it probably is unlikely that we can help the customer now. What we need to be seeing is that customer has had a track record, and we understand that, you know, customers, people go through all kinds of instances, possibly where they've lost their job. They may have been on maternity where, unfortunately, they've not been able to get the income that they were previously had. There's going to be instances where customers maybe have got themselves into a bit of trouble, and therefore we can help them out of those.
Oh, we've just lost you again, Kelsey. There you go. Give it a second.
Apologies, am I back? Am I back?
There you go. You're back now, yeah.
Sorry. We can also look at customers that have had things like bankruptcies and IVAs. And as you can see on the screen there on your level 3, bankruptcies, you're looking at being discharged for 3 years. However, if you come across a customer that's had an IVA, we do expect that to be completed just over a year for us to be able to consider up to 80% loan to value. Now, what we're coming across is not necessarily IVAs. We are coming across customers that are within debt management plans or have arrangements to pay or are paying back debt collectors. Those type of customers we can certainly help. And with a debt management plan, if you come across a customer that's had a long-standing debt management plan, is currently in it, has been paying it into it, and is wanting a 95% loan to value mortgage, then we may be able to consider that. What you'll need to incorporate is the payment that they're making into the debt management plan. We'd want to make sure that that plan has been maintained for the last 12 months. So we're going to ask them to evidence that. And normally they'll get a statement from that debt management company covering that 12-month period. As long as they've been maintaining that, then we should be able to help them in that particular circumstances. If you have or are obtaining any credit files from your customers, then by all means, if you needed any assistance, because I appreciate credit files can be long-winded. I mean, I've seen pages and pages of credit files because understandably, lenders are not only looking at your customer's recent history, they're also looking at their previous as well on all accounts that have been closed down. If you needed any support with that, our team of BDMs either on the ground or in their office are more than happy to help with that. With our decision in principle system, when you key that through our system, we use Experian as our search engine. We'll pick up the information from Experian and we'll try and help you place that customer. So for example, if you've got a customer that is coming to us on a 90% loan to value, you key it through our system will automatically try and put that customer onto the best product available, and that would be on our level 1. Now, what it does is it will go to Experian, pick that information up from Experian. If we at that point find that the customer has had a £2,000 default that was registered 22 months ago, it's not going to be able to offer level 1 to that customer. However, it will come back and offer level 2 in that option. So then you can go back to your customer to say, we can't have this particular product, but we can proceed with Aldermore with that. So the system will try and help you with that. We do a soft search at decision in principle. Tim, if you're going to move on now. So that's how we can help customers that have had some credit issues previously. Self-employed, I know it's a big topic this morning with James and Lee covering it. We are one of those lenders that, yes, can consider 1 year's, Tim. I know you were waiting with basic breath about that.
Absolutely. Yeah. Can you go up? Can you raise the bar?
Yes. So we can raise the bar because we can look at 90% loan to value for those 1 years and that. In that instance, we are looking at using salary and dividend. Unfortunately, we can't use net profit and salary at that point. Excuse me. However, if you have a customer that's been trading more, so 2 years plus, we can look at using net profit after tax plus salary as well. We can also use the latest. Our decision in principle system will automatically use that latest figure. And even if you've got a customer that, say, it's been relatively new business, in your first year, you made very little. The second year, you may have jumped from 10,000 to 20,000, and suddenly that 20,000 has now jumped to 80,000 in that third year, then we can look to use that 80,000. Now, of course, we're going to substantiate that. You'd have to do the same with James at Kensington and Lee at Saffron. And what we're talking about is looking at the sustainability of that figure moving forward. So things like an accountant's certificate we can obtain to get that sustainability. Also, if you think in that situation where we can look at using the latest figures and we can look at using net profit after tax and salary, if that income then moves from under 60 to over 60,000, we can then look at putting them into a higher affordability bracket of up to 5.5 times income. So if you think about it, I know a lot of high street lenders will look at using latest, but sometimes they will restrict what percentage they'll do. If you look to us as specialist lenders, we can use the latest, and as long as we're getting that substantiating evidence from either bank statements or from an accountant, we can look to use that, and it also helps out on the affordability side of things as well. One thing I wanted to touch on about contractors, and I know the high street lenders like Halifax and Skipton do brilliantly in that market. We do contractors. Where we try to fit in is whereby you may come across customers that have had gaps between their contracts. So that could be, you've got a customer that's either been off sick, you've got customers returning from maternity, whereby as long as we can see there's been a track record in there, we can look to help. We don't automatically expect a contractor to be able to fill a full year. Usually people move into contracting because maybe they only want to work for 9 months of the year or 6 months of the year. So a lot of the time we're going to be working off their history. We also as well, if you ever come across it whereby you've got a customer that has recently set up, for example, as a limited company, and they are a director and they have a contract in place. Now we can look to use that contract and look to use their employed income rather than going down the self-employed route. So what I mean by that, I'll give you an example. We can look at it if, say,
Oh,
Say, for instance, you've got a customer who were company for 5 years.
Sorry, you
Am I
just cut
back,
out for a
Tim?
split second there. Yeah, if you just want to restart that little bit again,
Sorry.
please.
Sorry, yeah. So yeah, you've got a customer, say for instance, they worked within an IT department and they've worked for the company and on an employed basis for 5 years. They then left, they've set themselves up as a limited company and a limited company director. Doesn't have to be a limited company, could be sole trader. And they've been, I don't know, 3 months, 6 months set up. They have a contract because the reason they left their employed permanent role was that they knew they had a contract and they knew they could earn more through doing that. They have that contract and that contract is in place, for example, another 12 months on an employed basis, not having to say to them, Mr. Customer, we're going to have to make sure that your company's been trading for at least 1 year in order for us to use that income. If you have a contract placed in place, there may be an option for you to use Aldermore. We just need to understand about their previous experience and what that contract looked like. Tim, can I ask you to move on to the next slide then, please? Thank you. So buy-to-let, as I mentioned earlier, 75% of our business that's coming through the door is buy-to-let. That's a big U-turn for ourselves from many years ago when it used to be residential. And I know there are a lot of buy-to-let challenges at the moment because you've had the stamp duty increase, affordability issues as well. We've got the Renters' Rights Bill on the horizon for those particular landlords, potentially landing next month, who knows. But also we see it at Aldermore that there's great opportunities in that particular sector. I think UK Finance at the beginning of the year indicated that the buy-to-let sector would increase by up to 14% this year from last year. So that would have been an increase up to 38 billion. And there is anticipation as well that next year will be an increase as well in volumes and that. So it uplifted another 11% to 42 billion. So there are still opportunities in that particular sector. We're seeing landlords diversify their portfolio. So looking, of course, at HMOs, multi-unit freeholds, and even some of those moving into the semi-commercial as well. Statistics by Hamptons has indicated that 70% of all new buy-to-let purchases are within a limited company structure. And we can kind of mirror that with our business split as well, which we've probably seen between 65 and 70% of the buy-to-let business that comes into ourselves sits within limited company. Tim, can I ask you to move on to the next slide, please? So where do we see ourselves differently to that of the high street? So as I mentioned, 75% of our business is buy-to-let. The majority we're seeing come through the door is limited company. Limited company, we've set ourselves up for that type of business. We're a little bit different. We can go up to 6 directors, shareholders and individuals. We do expect all directors to be named on applications for limited company. However, we do not expect necessarily all shareholders to be on there. If your shareholding is more than 25%, then yes, we'd expect you to be on the application. However, we do come across it where customers have set up either SPVs for them from an inheritance tax perspective. And we're coming across that where these SPVs have been set up where you've maybe got children on those with a very small shareholding. In instances like that, we can definitely help, definitely worth speaking to either our internal BDM team or the field-based team that we have out there. So limited company we can look at. We can also look not only just at SPVs, but we do look at trading companies as well. So we'll look at, we've done a number where it's maybe the properties have sat within a dentist practice we've done it where it's sat within a plumbing business, etc. So we can have a look at that. We don't set our sights on having specific SIC codes. So you don't have to necessarily have a SIC code to be able to come to ourselves. We do also look at layered kind of setups as well as a limited company. So we do come across it whereby there may be a holding company under the limited company structure. Also, we come across it whereby a shareholder within a SPV could be a trading company. So you could have a setup where a trading company is the 50% shareholder and the other 50% shareholder is an individual. That type of scenario we can deal with. Also, we're coming across, or have been coming across, incorporations where previously customers have held buy-to-let within their own personal names and now wanting to transfer them through into a limited company or purchase them into the limited company. We can certainly help in those particular scenarios as well. We're okay with things like directors' loans and, of course, intercompany loans as well, so we can accept that. We're also good with customers that have large portfolios. As a lender, we can lend up to 10 million. We don't, we have no concerns about how much is in a customer's portfolio. We have a great proposition, which is our multi-application proposition, which helps portfolio landlords. And this is where you're able to process an application, a buy-to-let application, whereby we can look to put more than one property onto one application. So, for example, we come across this scenario if you're dealing with landlords that are wanting to remortgage, coming off onto SVRs. All you need is a minimum of 2 properties. So this multi-property application that we can consider is between 2 and 30 properties. What you do in that instance is that you would submit your application online to ourselves. As I say, it will be one application. You then add as many as up to that 30 properties onto that one application. It would then be underwritten as one. So it comes into us one. It's only one packaging as part of that for yourselves to upload on our system. From the customer's perspective, it's only one direct debit payment to be made, and we will deal with it as one loan. So it goes into one underwriter. We do, however, instruct valuations separately, and we can then blend. What we do is blend the loan to value and the rental across the application. So I'll give you an example of we've helped customers. We did one recently where a customer had 2 properties. He had property A, property B. Property A was sat at 80% loan to value for buy to let, and although we can do 80%, the rental wasn't adequate to just cover it on its own. So that broker advisor was speaking to their customer to think, we're going to have to keep that one out and maybe look at that next year when potential property values increase. However, property B was sat at 70% loan to value and the rental was more than adequate to support it. With our multi-property application, because we added both of them onto one application, we then blended the loan to value and of course the rental, we were able to do both of those for that particular customer as part of that. Now, don't think of it as if we can only just do 2, we can do 5, as I say, 10 as application. Now, the great benefit of the multi-property, not only from an administration point of view for yourselves and from the customer's point of view, but you'll align one product fee potentially, or we do have product fees, 0 product fees as well as part of our product range. In that instance, we were able to offer free valuation. We'd offer free valuations on all our standard purchase buy-to-let and remortgage. So we were able to offer free valuations on both of those particular properties. In this instance as well, it was in a limited company. And because we only needed one personal guarantee, which of course then costed cheaper to that customer. So if you think about it, if you're dealing with your portfolio landlord customers and they've got a number coming up, it may be worth looking at them as a whole onto one application where they may be charged only one PG rather than separated them and then being charged maybe individual by the same lender or by different lenders. I'm just conscious of time, Tim, so I'm going to move on to the next screen. But if you guys have any questions around buy-to-let, then I'm more than happy to pick up after. Pop a question in the chat, or I can send contact details through as well. Just want to quickly move on around our DIP guarantee. So we have a guarantee in place, and yes, it's for 10 days. And you think, oh, other lenders have DIP guarantees in place for longer than that. Well, what we indicated is that with our 10-day DIP guarantee, what that means is if we ever pull products, which of course lenders do, we try not for it to be at the last moment, and we do try to give you at least 24 hours notice. However, all you need to do with ourselves is complete a decision in principle. That's all we ask. You don't need to be hurried, speeding along, trying to get your customer to complete it, send documentations. You just need to complete a decision. What we then say is that we will save that product for 10 days. So that just gives you some breathing space to collect the documentation to then submit the application. We then give you another 10 days to upload the documentation. So in essence, we're giving you 20 days, nearly 4 weeks to actually save that product for that customer. Of course, if we make those changes and it's in the benefit of the customer, the products that we come out, you can make those changes for that customer as well. Tim, just moving on, as I say, I'm just conscious of time and running over, that's all. And the only other thing I wanted to touch on was to say around product switches. We are one of those specialist lenders that does allow that. We have a system which basically we class it as the 6 clicks. So if you've got any residential customers with ourselves or any standard buy-to-let customers, it literally is on the system. You can access the customer's information. We do 17 weeks out, we do send out to yourself prompts to say you've got a customer coming up for a PT before we'll actually contact the customers direct. Thank you for listening. Thanks for your time. Are there any questions, Tim?
Thanks very much, Kelsey. Really good. Very comprehensive presentation there. Again, apologies to our audience for the slight sort of dipping in and out of the sound quality there, but I think we managed to get everything. Have we got any questions asked? No, none as yet. But really sort of good to hear the sparring continues. You know, loving the bit of the competition there. Caroline's earlier question about sort of concessionary purchases, hearing that you can do that for landlords is really good. Yeah. So some good bits there, and obviously that competition to do with 1 year's accounts and usable income on self-employed keeps on getting better. So yeah, really good. For me, some sort of takeaways at the 3 levels of adverse policy, ignoring obviously small CCJs, defaults, really good. Wasn't aware you could obviously do stuff for clients who are currently in a debt management plan. Interesting that you obviously looking to consider that, which is really good. And you've got that pragmatic approach, likely at the Saffron to do with contractors and also gaps as well. So nice to hear there's that. But certainly the buy-to-let space and your comprehensive offering, you know, in the buy-to-let space with all the different types of properties, all the different structures that people are now setting them up in, and also the ability for you to allow directors' loans, all really good. There have been 2 questions now, one from Philippa. On the credit table, it didn't mention missed payments on CC's credit cards. Can these be ignored?
Yeah. So so anything to do with late payments, we do just expect the latest one to be paid. So for example, if you looked at a credit report and the last one was saying a 1 on it, then we wouldn't. Outside of that, we'll take a view to do with late payments, hence why we're just looking at the defaults and CCJ side of things. So definitely can have a look, and if you need any help and support, then our team are more than happy to help.
Perfect. And our last question is from Caroline. Can she ask about tenant types, please? So again, I would imagine this is to do with potentially what more and more brokers are seeing, which are these corporate lets to some of these housing association schemes. What's your view on that, if that's okay, please?
Yeah, sorry, I should have probably touched on that. So corporate lets we can have a look at. So maximum tenancy would be 5 years on it, and it is mainly to housing associations, charities, councils. If you have a look on, there's a government housing list, council social housing list. That's where we would look to, or our underwriters would review that particular charity, as I say, housing association or council on there to make sure they're on that list for us to be able to support. Yes, but certainly can help.
Okay, perfect. Well, thanks very much for that. Really appreciate you supporting today. Really appreciate it. Thanks very much. We are now going to move on. We're now going to move on to Roger Holmes, who is our TMA Specialist Area Supervision Manager. Are you there, Roger?
I am here, Tim. Yes, I am absolutely here. Thanks, Tim. Yeah, morning, everyone. Tim, could you click onto the next slide for me, please? So today what I'm going to look to do is just run through a few areas. So a bit of a high-level overview of the Mortgage and Protection Review. It's always worth just covering off again around the FCA's views on vulnerable customers, and then just want to talk through some best practice hints and tips around file quality. So we got some feedback from our sort of case checkers, and just wanted to spend a bit of time sharing some views on that. And then we'll just sort of finish up the session just referencing really some of the benefits of compliance support that TMA can offer for anyone that doesn't actually have the compliance support package at the moment. It might be something to worth considering in the future. So next slide, please, Tim. So mortgage rule review. So it's a discussion paper going on that's coming to a close sort of imminently the next few days. So what the FCA is looking at doing is they've been targeted really about trying to sort of really grow the market, and as part of that is they're trying to understand what they've got in place at the moment, where there can be some tweaks and changes. They're looking at maybe revising the lending rules to hopefully support wider access to home ownership. Is the current regulatory framework and the market, are they really set up for the increase in later life lending? It's fair to say we're an aging population. It's definitely becoming a lot more mainstream. So they need to make sure that the regulation is sort of fit for purpose in that regard. Also, can there be more flexibility? Really trying to promote sort of consumer understanding. And then basically rebalancing the whole sort of collective risk appetite in the mortgage market. Next slide, please, Tim. So a couple of the key areas. So definitely they're looking at affordability. So the potential changes in the way things are stress tested. Obviously looking at, within the discussion paper, scrapping the 5-year fixed term that's been used, maybe adopting a rent-based approach. The FCA is really keen to offer more support to sort of underserved borrowers, in particular, first-time buyers, self-employed, and those on variable incomes. Vulnerable customers, the FCA said, their rules could be simplified to support vulnerable borrowers. So including those with, joint mortgages and victims of sort of economic abuse. There's been some suggestions that the regulator needs to maybe look at adopting a principles-based approach on affordability, and hopefully that will start to improve some of the customer outcomes and reduce some of the barriers there. So they're really seeking to sort of try and get a bit more guidance and clarity on when affordability assessments need to be really used. Next slide, please. Another couple of areas. Oh, we've gone back. Sorry. So interest only. What are you doing to me, Tim? So interest only and shared ownership. So from an interest only side of things, it's like how can we support part and part mortgages? Sale of property, is that really a credible repayment strategy? And equally, how easy is it for customers to move between repayment and interest only without having to go through a complete new process, setting up new repayment vehicles? And then also they're looking at shared ownership. So the regulator's not sure whether or not its current rules are sort of acting as a bit of a barrier, and maybe adding sort of disproportionate costs to these types of loans. And also on later life lending. So as I referenced earlier, that it is becoming a lot more mainstream, and the demand absolutely is still going to continue. FCA is not convinced that its rules aren't sort of hindering innovation sort of in this space, in particular on things like RIOs. So obviously when they designed the RIO sort of product all those years ago, it's fair to say it's not really become a huge product offering. But actually, on reflection, is it some of the rules and regulations around that's actually restricting some of the lending? So that's definitely a key sort of focus area that they're looking at. Next slide, please, Tim. So a couple of the sort of like key outcomes that they're looking at on the back of this discussion paper. So fundamentally, they wanted consumers to have more choice on how they deal with their mortgages. So the engagement with the mortgage provider without possibly needing full advice. I know that's probably going to be a bit of a swear word to those that are on the call here, but that's what the regulators sort of considering as part of the discussion paper. Also about how easy it is about people reducing their terms, with the ultimate end goal about reducing the total cost of borrowing, which means obviously that's going to be of a financial benefit to people, and just making sure there's real ease of access to the cheapest sort of products that are available. And they're just wanting to get mortgage regulation simpler, so that people can really understand the expectations from a regulatory point of view. Put on this slide as well that, you know, if anyone's really interested, there's a really sort of useful podcast, Mortgage Mingle podcast, that's about a 20-minute summary of some of the slides. It's been created by AI, but it's definitely worth a listen. Next slide, please, Tim. So the protection review as well. So obviously that's due to basically release its interim report in Q4 of this year. So from the protection market study, they were primarily looking at life insurance, CI, sort of term insurance and income protection. So it's not about protection where there's sort of savings and investment elements, or again, private medical insurance or funeral plans. From an intermediaries point of view, the FCA is also looking at the final costs to the consumer, so any related commission structures, fees or charges, as well as what sort of in-house remuneration might be going on in the intermediary market. Next slide, please, Tim. So within that, a little bit more detail. So distribution arrangements and commission. So FCA is very much keen to sort of analyse the effects really of the different sort of distribution channels. So within that, it's looking at panels that people might use, whether or not, you know, a whole of market or tides, do they have single tie, and what impact, more importantly, does that potentially have on customer outcomes? And as we also previously mentioned, it's looking about the sort of commission structure as well. Under the sort of remit on fair value, FCA is concerned about the value of guaranteed products. So in particular, things like the over 50s insurance is trying to understand really what's the actual quality of the product versus the overall price that a customer pays over the term of the product. Competition, there's been, you know, a reduction in the firms in the market. So the FCA wants to explore and understand what impacts that may have, and also assessing barriers to new entrants coming into the market. And obviously, the more people that are in the market, that's gonna drive the competitive arena. On a protection gap, so it's trying to understand really across the market if there's a gap primarily around vulnerable customers, those with potential vulnerable characteristics, are they underserved? And if they are, you know, basically what can we do from a marketplace to try and bridge that gap? Next slide, please, Tim. So some of the things that have sort of come out so far, so really trying to understand distribution strategies and the reasons why products are set up and how people use them. Understanding remuneration, the use of loaded premiums, whether or not people were in single tie arrangements, any fees that are charged over and above the cost of the insurance itself, and also linked in with that if there's any sort of additional services that are offered, such as trusts or power of attorneys, things like that. The sales channels that are used, and how they sort of meet customers' needs, and more importantly, how they're then adapted to meet the needs, again, linking in with vulnerable customers. And as I've referenced earlier, you know, there's a big interest in the guaranteed over 50 plans. Next slide, please, Tim. So, as I said, just going to talk a bit about sort of the FCA's view around vulnerable characteristics. So these are just a few points that the regulator just feels that are sort of negative points, really, that are worth consideration. So they felt that most firms aren't monitoring for poor outcomes in customers with vulnerable characteristics. And naturally, if that's the case, they're not necessarily putting some actions in place to sort of move things forward. They felt that there was few firms that can actually demonstrate that they really consider how they include customers within that have, you know, vulnerable characteristics. So looking at the products and the designer products, so that's all linked into the fair value assessments that all the providers do. It's really important from their point of view that we identify sort of characteristics and build that into the target market. There's poor examples of outcomes of firms being quite rigid in terms of their service proposition. Digital journeys, so some with learning disabilities are sort of, you know, pushed down a digital route. And the next point, it talks about 65% of customers with learning disabilities are pushed to the online journeys. Said that the service then didn't really meet their needs. And sort of, if you reflect on that, that's quite a high percentage. And also they found that some firms have quite a low awareness about alternative support. And also, you know, less than a third of firms are sort of testing whether or not the outcomes for those customers are good or poor. So they're not really sure whether or not they're meeting the needs for the customers. Next slide, please, Tim. So this bit is talking more in particular about smaller firms and what the FCA's view is. So small firms, they need to meet expectations, but naturally being a small firm, they shouldn't and wouldn't necessarily be able to incur huge costs. What they have said is that they don't want small firms to just put something right when it goes wrong, but make sure that they take the time to sort of review their process so that everyone can benefit from any learnings. Communication needs to always be in plain English. It's key that everyone in a firm should have training on the subject. It's accepted that in some small firms there may be like one key person that's more of a specialist, but that doesn't preclude the fact that everyone should have a basic understanding about how to deal with customers with vulnerable characteristics. FCA feels that small firms have a real advantage, that actually they tend to work really closely with their customers, and really they should really take that experience about them working closely and share that expertise amongst the firm. And they shouldn't underestimate, you know, the information that they have. It's really key for monitoring. Small firms, as I said, that, you know, they work better with their customers, and it's because they tend to tailor their journey a lot more. They're not one huge sort of sales machine where it's almost like a scripted sort of process. It tends to be a lot more independent by definition in its approach. Next slide, please, Tim. Just going to talk through some hints and tips really around file quality now. So this first slide, these sort of apply to both mortgages and protection. And it's just things that are worth considering. So talked a lot about vulnerable characteristics. So as part of your file, if you've made any process changes or you've offered additional support, if you signify that you've feel that this particular customer has a vulnerable characteristics, it's always important to make sure that you've recorded any changes that you've done or any additional support. File itself, make sure that it covers the whys and the whats. You know, it's always about telling the story when you put a file together. And a really powerful way of doing that is making sure you're actually using the customer's own words. It really adds value when you're compiling your file. Make sure that you always add any relevant sort of documentation that sort of basically just bolsters up the sort of decision making process really. So if there's been changes at any part of the journey, if there's rated premiums, if you've got documentation that backs that up, make sure that that's part of the file. It's always important that files are chronological to demonstrate the advice process. You wouldn't expect to look at a file and see that we've submitted something to a lender without validating who the customer is, and that we've done our due diligence around the sort of address and ID side of things. Always make sure that we emphasise the importance of full disclosure and make sure where possible, if there's a way of demonstrating that the customer really understands the process that they're going through. Next slide, please, Tim. So from a mortgage specific point of view, a few things to consider. If you've selected a provider that isn't top of sourcing on mortgages, make sure that your file's clear as to the reasons why. Cover why the product type and the product term is appropriate. So always try and personalise your recommendation letters so that it's clear why something has been selected. Again, linking into sort of, you know, later life lending. If a mortgage is going past its retirement age, have you done any sort of due diligence to make sure that you're happy around the plausibility? You know, if they're going to be changing roles, is there transferable skills? You know, does it all make sense really? And again, there's just another point there, just referencing, you know, customer ID should be completed prior to any sort of application to any lenders. Next slide, please, Tim. So from a protection specific point of view, always consider, you know, how was the sum assured calculated and why is the term appropriate? If you're looking at family protection, make sure that you've covered discussions versus, you know, sort of level term, family income benefit options. If you're going to be switching cases from a cover point of view, then you need to understand that you've explored everything. Have you got evidence of what the existing policies provided versus what you're going to be replacing with, and make sure that the customer really understands if there's been any trade-off from losing one type of cover and the benefits that they're going to be getting by getting the new policy in place. If you've got any add-ons that are going to be put on to a policy, make sure that it's clear from the file any sort of individual cost for that add-on. If you've set critical illness or income protection for a mortgage term, and the mortgage term is due to finish before a preferred retirement age, have you considered that obviously the need's still going to exist? If they're still going to be working, yes, the mortgage may be paid off, but the benefit need could still be there. So make sure that your file covers that. indexation and waiver of premium. Make sure that these are all sort of covered off in your files, and also from a trust point of view. So if you've discussed whether or not something's going to be put in trust, but it hasn't necessarily been completed online, has your file got an audit trail about whether or not you've got some sort of chase in place to make sure that the form's been completed and returned? The key bit on that is if you've set up a policy and you've advised that something is put into trust, and we've then not followed it through, then, you know, potentially if there's a complaint at a later date, it's about safeguarding yourself really from that point of view. Final slide, please. So just a bit of a shameless plug really from a compliance support side of things. So some of the things that our support packages can offer. So as part of the packages, you get third-party file quality checks. So that's a really great way of about being able to evidence the quality of advice that you produce. It's a great source of MI, and having additional MI is really good for your when you're pulling together your annual board reports that are due each July, that are obviously sort of like pretty much linked in with the consumer duty side of things. When you're applying for lender panels, seeing a lot more now where they're actually asking whether or not you have compliance support, what that compliance support is, who it's provided by. So it could definitely be of benefit there. We have regular compliance newsletters that are posted out to our compliance customers. You get access to compliance documentation. So there's a whole host of templates, guides, procedure guides for people to be able to look to. You have access to people like myself to be able to bounce ideas off of and use as a sounding board really. So our specialist area supervision managers. And from a financial benefit, anyone that has a compliance support package, Howden's also then offered discount for PI. So definitely worth something to consider, and you can save some money. So timing, I think 3 minutes to spare. I tried to be as prompt as I could, Tim.
Thanks very much, Roger. Really sort of comprehensive section there. Thank you. Yeah, I mean, a couple of sort of takeouts for me before sort of opening up to any questions. Please, obviously, don't forget to put your questions in the Q&A section. Obviously, the mortgage discussion paper, quite a big one. I was on a webinar yesterday, and the FCA discussion paper, it's open to all brokers to go about reading. I was quite shocked at how many people hadn't read it and have no intention of reading it. Yeah, this discussion paper ultimately affects your business and what's coming down the pipes. There's a lot of talk that you didn't go into details, and I'm not going to put you on the spot, Roger, about advised versus non-advised, which seems to be sort of like the big thing that many brokers are sort of looking at and questioning. And I suppose, if you have got a thoughts or feelings on it, Roger, is that I suppose the takeaway for me is the FCA is obviously sort of looking at opening up the market, growing it more. They're worried about sort of vulnerable customers, but that seems at odds if they then want to increase the amount of non-advised discussions and conversations and sales processes that happen on that vein. What's your thoughts, if you've got one on that little nugget? I suppose this is probably more than sort of like a couple of minute conversation, so maybe one to think of, but it's certainly sort of a great plug to look into it a little bit further if you have.
Yeah, I think it's a really interesting question, Tim. I can see that I would imagine the regulators probably feeling as though they're almost stuck in between a rock and a hard place. That they've got down one line the government sort of saying you need to open the market up, deregulate, and we need the economy to grow, and it's almost sort of one side I can envisage they're thinking, right, how can we do that? Let's get more transactions happening much quicker, and you can see there's a drive there, but without, which is probably why there's a discussion paper, without necessarily thinking about the potential ramifications that could have a negative impact on a huge part of the economy that is the mortgage market and the advice sector. So it's, I think it's almost like they don't really know where to go. So it's like, let's chuck some things out there and see what comes out. Which is where I can see benefits, but I can see a huge amount of risks from a personal point of view as well. But that's sort of my sort of personal take on it.
Yeah, I mean, my personal thoughts are 90+% advice is a great sort of milestone that we've achieved. Trying to move more down the non-advice seems a little bit sort of narrow-sighted. But I suppose the other sort of key takeaways from it is that some of the positive moves in that later life piece. One of my sort of passions is that later life segment and the fact that we're all getting older, and there's going to be more of us that are going to be needing mortgages that go well into retirement, and that sort of grey area that sits between mainstream and those sort of equity release stroke lifetime mortgages. So quite a few building societies moved into that space already and are offering more sort of flexible approaches for those clients. But yes, certainly looking at how to make the best of that, it is quite good. Some really good sort of great tips you shared. Thanks very much. Certainly those tips about sort of personalization using clients' own words, and certainly on the protection, where you're adding up the protection terms or there's slight discrepancies between terms, just putting that extra layer of rationalization on there to help sort of file checks, etc., is the thing that commonly pops up quite a lot of the time. So do that. And of course, here at TMA, we can help you with a varying different degree of compliance options. Okay, Roger, it looks like you have got off the hook. There have been no further questions. So thank you very much. We are sort of bang on time. So thank you. I'm now going to pass over to Mark. I'm going to stop sharing my screen in the hope that you can share yours. Mark, hello. How you doing?
I'm very good. Thank you very much, Tim. I've just sent you a request. If you can just verify that, then I can share. There we are. Excellent. Okay, hopefully you can all see that.
Give it a second. It's just
there we are.
There we go. I can now see the value of underwriting claims. Yeah,
fantastic. So I'll crack on. So yeah, thank you for the time this morning. We've got half an hour, so I'm going to whiz through this subject. And the point of this presentation is just to make sure that everybody is focusing in on the right things. Just to follow up on what Roger was saying there, that the FCA have said many times before that the value of a proposition for protection is the most important thing. Affordability is part of that, but it isn't the only thing. And the third thing that one should be concentrating on is this policy going to pay out, and is it going to benefit the customer? So those are the three sort of core elements of advice that the FCA have always said are key. So focusing on claims is no bad thing, and claims is the point. It's why do we do this in the first place? It's all about the fact that this policy will make a significant difference to those people at the point of need, when they need it most, to their businesses, to their families. And it's very, very important that as a team, we underwrite, as an industry, we underwrite policies correctly, and we ensure that claims are more likely to be paid. So it's also paying claims of empathy, and the quality of claims teams is very important as well. So that's what I intend to go through here in the next half an hour. That's a sort of a quick brief of the agenda. So what is the value of claims? So let's first of all pat ourselves on the back, because in 2023, £4.85 billion, massive figure, was pumped back into the UK economy to help people at their worst possible moment in times via claims. It's £4.85 billion. So we should all applaud ourselves, because clearly we're doing a fantastic job for those customers that received that money and the difference it made to their lives and whatever the circumstances was. 3.47 billion of that was life claims, and 1.2 billion was critical illness. If we looked at EB as well, we threw EB into that, it would be 7.4 billion would be the figure. So a massive amount of money going into helping people at the point that they need it. And so what is the difference that's making to people? Well, you are, by having provided that, providing life continuity to those customers. You're providing a circumstance where whatever the situation, they can allow their beneficiaries, whether they are still alive or not, or their beneficiaries, to continue to live the life that they wish to lead. To eat the food they wish to eat, to take the transport that they wish to take, to continue to have the hobbies, pursuits that they love to do, to continue that nobody wants their life to change. So to continue to have that kind of life. Secondly, maintenance of life essentials. So the ability to continue to service the mortgage debt or pay off the mortgage, to all the other debt that you might have to consider to pay that, to make sure that you can still fund the investments that you've had in the first place with the flashing beacon of wealth that's out there in the future, whether that's retirement or an investment pot, doesn't really matter. You're not going to draw on that early if you've got enough money to continue to invest in those policies. So really, you're providing the ability for that customer's life to carry on as it was before. But one of the single biggest things that you're also providing in a claim moment is the removal of financial stress. Now, there is absolutely, I mean, you may have heard me talk about financial resilience in the past. It's been a big topic of conversation for HSBC Life for the last couple of years. And financial resilience is a great lens through which to discuss protection with a customer, making sure that the customer understands the consequences of inaction and that their need goes way beyond life cover, that actually income protection is the most important thing. Don't ignore critical illness. Income protection never replaces critical illness. Income protection gives you an income to continue your life. It does not therefore pay for the debt and the things like that you need to worry about, or the cost of care. That's where CI comes in. And then life cover really should be the last thing that we're discussing, because it's the least likely event to occur, and it should be that direction of travel. Financial resilience is really, really important to protecting people's financial stress. Financial stress is related to mental health. Those things are absolutely linked by making sure that people can claim against policies, protecting their financial resilience, you are also improving their mental health as an absolute link. So the value of claims is boundless, and we should all be applauding ourselves for that. But what are the reasons why claims don't pay? And I want to get into that for a moment, because it's really important that we understand about non-disclosure and what happens. So with critical illness, half of the cases half of the claims that are turned away are not met the definition. That's fine. In terms of the other half, it will be non-disclosure, and it will be one of these two non-disclosures. In terms of life cover, it's either fraud, somebody's still alive, they're not dead, or it is non-disclosure. For when you're looking at that 3% of claims that aren't paid, a significant number will be non-disclosure. What was the point in the policy? What was the point in all that premiums, all that effort, our effort, your effort, the customer's premiums being paid, for it not to pay? Ridiculous. And we should do everything we possibly can to avoid non-disclosure. So let's have a look at what non-disclosure means. Let's kind of define that before we look at ways of avoiding it. Fraudulent non-disclosure is the most serious. This is where the customers deliberately or recklessly lied about their disclosures. This is the most common of those is alcohol, not to be confused with the amount of alcohol we all drink. Underwriters know we lie about that and are probably adding a significant percentage to the figure we disclose. No, that's not necessarily the problem. The problem is a medical condition that has been caused by alcohol, or alcohol consumption that has had a warning from a doctor and you should lower that, or it's causing further medical conditions. That's the serious alcohol non-disclosure issues that we face. The outcome of that will be that claims will be declined, policies will be cancelled, and depending upon the circumstances of the non-disclosure, premiums may or may not be returned. But nobody wants that. Nobody wants that sort of circumstance. We certainly don't. And certainly If you as an advisor were seen to have a significant CFO or lapse rate, that would affect your agency with us, and it would potentially, obviously you're in a significant network, but it would potentially affect your reputation with the network and the commission rates that we would be willing to pay. Negligent non-disclosure is a careless, negligent, where the customer just is unaware or have forgotten about the disclosures. And this is going to happen. You can't control what the customer says. You can make sure that you ask the questions in the right way, and that's what we're going to get to in a moment. This is very embarrassing as a customer gets less than they were expecting, because if, say, for instance, they didn't disclose they were a smoker or an ex-smoker, then we're going to say, right, well, you should have been paying smoker rates from start the policy. We're going to take all of that unpaid premium out of the claimable amount. You'll be getting a partial payment. That's embarrassing. Nobody wants that. That payment is necessary for certain issues at the point of claim, necessary because the customer is going through some awful moments. Nobody wants that, to have that conversation. The most significant negligent non-disclosures to diabetes, outstanding investigations, BMI is the most significant one, and smoker status. But most of this, not all of it, most of this can be avoided. Again, you cannot control what a customer tells you. But when asked, as Jen Carhart, our head of underwriting and claims, said, when asking a question, read each question slowly, read it the way it is written, and remind customers of their duty to disclose and the potential impact of not providing accurate disclosures. Let's look at a couple of examples where policies were declined on a claim. So this one is a non-disclosure at claim stage. The customers disclosed 3 life policies, applications January 21, 24, total sum assured £345,000, non-smoker disclosed 1 unit a week. Nothing really there to be concerned about. Who drinks 1 unit a week? Not sure that's potentially true, but never mind. Underwriters wouldn't worry about that too much. A life claim was submitted in March 2025, so not long after the policy, the 2024 policy was put on risk, but again, not necessarily a problem. However, the cause of death was alcohol-related liver disease. Now, anybody that knows anything about that particular illness knows that it's a long-term illness. It's caused by long-term alcohol abuse, much more than a year. Information obtained from the hospital established alcohol history over 10-year history, excessive alcohol consumption, liver damage consistent with long-term alcohol abuse predating the policies. Of course, we declined the claim, and the policies were cancelled. Now, there's something that's not often understood is how we underwrite policies. We all know we underwrite policies at outset. We also know that on a claim, we are underwriting the claim. So we're basically saying, give us the evidence. Let's go and get the evidence to prove that the claim can be paid. Right? That's a form of underwriting because we're checking information. We can't fish, can't look for other information. We can only underwrite, get evidence for the claim that's being proposed to us. However, there is another form of underwriting that customers may or may not know about, and I suggest to you that you explain to them that this happens. All life companies do post-sale sampling. That is, after the policy has gone on risk, we request a GPR on a sample of cases. That's between 5 and 10% of cases, depending upon which life company you deal with. HSBC, it's 5% of cases. We get that GPR in, and we then check that off against the disclosures on the form. And if there's any non-disclosure there, then it will cause us to go back and review the case and potentially remove the policy. Explain that to customers. Make them stop and think that if they were going to non-disclose, or they don't give it serious thought about disclosures, that they do so, because there is a high chance that we're going to find information. It's a bit of a lottery if you want to take that risk, or alternatively, we're not going to pay on claim. Explaining the process is one of the most significant ways of improving non-disclosure. And this is an example here where the post-sale sampling picked up an issue. Application for only £20,000 life and kick. The customer disclosed non-smoker, height 180, weight 67, no issue there. Occupation bar assistant, fine. Medical disclosures, had anxiety, had no thoughts of suicide, first symptoms 2016, taking medication, 1 episode, no time off work, doesn't affect me, last symptoms 2016, alcohol 20 units a week. No doctor's advice on giving up. So again, all good. And certainly from an HSBC Life perspective, and we like to see with mental health disclosures, the customers have sought help, that they've got a diagnosis, that they're taking time off work, that they're on a treatment. We like that because it means the customer's looking after themselves. And so that for us would have been an ordinary rates decision. However, the post-sale sampling GPR came in. Oops. Excuse me. And the evidence came up this. They smoked 10 a day. When they weren't drinking, they were using cannabis and cocaine. Alcohol was 65 units a week and had been advised to reduce to seek specialist support. Noted high alcohol and associated with occupation as a bar worker, which is not a great combination. And noted cannabis and cocaine use 1 month prior. So would have been declined on the manual in 2 different situations. Just a little note here on the cannabis, that's ordinarily treated as a smoker rate, not necessarily a concern. But when you do a disclosure of cannabis, then actually that's a bit of a red flag to look for other dependencies. And when you've got other dependencies as well, like cocaine, then that's instantly a decline. Resulted in withdrawal of cover for alcohol and drug abuse. Cover would have been removed following receiving a GPR. So that particular case, because of the post-sale sampling, we removed the risk. So what can you do to try and help the customer not non-disclose and to avoid non-disclosure? First of all, don't downplay the importance of questions. There are some difficult questions to ask in application forms. Yes, they can be that way, like the breast question, for instance, but they've got to be asked the way they're written. They're written in that way to seek a suitable answer so that we can underwrite it. Don't downplay questions. You don't have any of the following, do you? It's negative. That means they're suggesting to the customer, don't answer yes to this. Sorry, I've got to ask you this question. Again, it's downplaying the question and the importance of answering it correctly. Ask the questions as they are written. Express importance of answering honestly, including consequences of not. If any doubt, then explain to the customer the claims process. This is a really important one. Just because the customer discloses something doesn't mean that the cover is going to be more expensive or they're not going to be able to get the cover. Explain that to the customer. You know, there is a fear of disclosure. There needn't be. It's only significant disclosures where there's going to be any potential change to premium. And this is an interesting one. I know you can only see me on a screen and I'm sat down, but if I said I was 5'6" and 9 stone, you can probably see that I'm clearly not 9 stone. And if I stood up, you'd see that I'm actually 6'3". So if you're sat with a customer or on a screen and it just looks unreal, doesn't look right, I would suggest you ask them to go and get on a scales or go and get measured and make sure that it's accurate, because it's important that it is. And that's part of the BMI disclosure. So that's the kind of things that you might like to do from improving non-disclosure perspective. I just now want to just quickly go into a few elements that sort of lead towards claims. And the first one is that when you're talking about critical illness, you're not actually talking about one product, you're talking about 2 products, because it's different for men and women. If we look at those statistics on the screen, it looks like it's mostly the same. But if I then said to you that for multiple sclerosis, women are 4 times more likely to get multiple sclerosis than men. For dementia and Alzheimer's, it's 2/3 female. Heart attack, men are more likely to have a heart attack, but women are more likely to die of a heart attack. Devic's disease, 3 to 1 for females. And for Parkinson's, 1,800 diagnosed last year, in 5 to 1 in favor of men. And for cancer, it's significantly higher chance for women to have cancer at a younger age, and significantly higher chance for men at older age. So when you're sat there talking to customers about the policy and how it might pay out and the benefit to them, it's worth reflecting on each sex differently and saying that this policy is beneficial to them, that they can claim against it in different ways. And that therefore them appreciating the value of the policy. How do you know if HSBC Life is going to be able to underwrite a policy? And the disclosures necessary do have a pre-sale underwriting tool on our website. If any of you have access to Underwrite Me, then Underwrite Me is clearly the great tool as well. But our underwriting tool on the website, I haven't got time to go through this now, but certainly you can put through any of the disclosures on their medicals, hobbies, pursuits, occupation, travel, and it will all lead to a decision, giving you an indicator there of whether or not HSBC Life can accept the case. HSBC Life doesn't collect GPRs. All right, so that means that we're able to smooth through, simplify the process. It does also mean, unfortunately, that there's certain size cases with certain disclosures that we can't take. How will you know what we can and can't take? The pre-sale underwriting tool or Underwrite Me is the answer to that particular question. So a couple of areas we can offer you cover on, which is different, is CI cover for type 2 diabetics. They have to fit this criteria. No diabetic related complications, no hospital admissions in the last 3 years due to diabetes, diagnosed after the age of 30, which the majority of type 2 diabetics would have been. Diabetic checkup in the last 12 months. BMI must be less than 38. Our BMI for non-diabetics, our max BMI for non-diabetics is 42 without the need of a GPR, which is incredibly high. Must not be a smoker. Refer always. We'd always refer to the nurse screening for every single time a diabetic applies for Life or CI. For CI, it's clearly only type 2 diabetics. And that in that nurse screening, we will be asking for a blood test. That blood test is just double checking the HbA1c readings in the region of what they have disclosed on the application process, so that we can double check that. And as long as all that's clear, results back within 3 days, we can offer that customer type 2 CI for type 2 diabetics. Some examples here of cases that we've been able to offer. The one on the left is right at the margin of our possibilities. 150% is our max rating, but that customer is really young when they've been diagnosed. They were diagnosed at 32. Very young. They've got a long way to go with the diabetes and avoidance of complications. So there's no wonder that we're rating at such a high level. Customer 2, older, live with diabetes for longer, clearly controlling it well over a long period of time, has less life to live with the illness. So we can offer a better decision there. So, it's 2 examples there of how we can offer cases and that it can be done. We're the only company upfront marketing type 2 diabetics for CI for type 2 diabetics. We're also really good at mental health disclosure. Now, I said earlier on we don't get GPRs. So this mental health disclosure is all off of the form and a nurse screening. Is the customer taking time off work, seeking treatment, getting a diagnosis? We see that as good. And I know, having worked at other life companies, that would be exclusion, or it could potentially be a rating. Whereas we're saying, 84% of the time we'll give you standard rates for these cases. Right, so do consider us for mental health disclosures, even though we don't get GPRs. The system is very likely to give you an answer. Example here. Mr. C, 39, non-smoker, have been struggling with some mental health issues following a stressful time at work. 200k life and kick. Works as a warehouse manager. 5'10", 15 stone. No issue there. Currently on a single medication prescribed by his doctor. Has had 3 separate episodes in the last 2 years. 35 days off in the last 12 months. I know that most life companies would exclude mental health from CI and potentially rate if they were to offer it. HSBC Life, we offer that customer standard terms. Claim statistics, the point of the presentation: 97.53% of claims paid, 94.4% of critical illness claims paid. I said earlier on that the reason for not paying claims is in that non-disclosure and not meeting definition. Don't believe life companies that say they pay out on 100% of life claims. It's simply impossible. All that they're doing when they say that is they have triaged out, filtered out the claims that they think might be paid and might not be paid before they're considered by a claims professional. It needs to be considered by a claims professional and not filtered out. And certainly with HSBC Life, those claim stats are reflective of the fact that every single claim is valid and every single claim is being considered by a claims professional. Multi-award winning, 7 awards in the last 2 years for our claims team. Fantastic claims team. I'll go through that in a bit more detail in a moment. The average claim turnaround is 19 days, which has improved dramatically recently to 13 days because we're now engaging with a company to get some of our medical report information, so much quicker on the claims. Unfortunately, children's CI is the 5th, nearly the 4th largest claim. It's a really, really disturbing thought. 85% of CI illustrations include children's CI. When you look at life companies that allow you to exclude children's CI, you've got to ask yourself, life changes, circumstances changes. Is that the most suitable thing for that customer, especially if they're younger? HSBC's children's CI is included in the contract. The Plus contract has Plus children's CI, and there's the adults children's CI definitions. And the core has the core children's CI on the adults core definitions. And when you consider what people do with the money, it's a wide range of things. What do people spend the children's CI policy on? Well, 38%, this is from the CI expert critical thinking report, 38% fund their children's treatment, what you would expect it to be. 29% cover expenses of treatment, traveling backwards and forwards, and if you want to get some private treatment. 29% improving health and well-being of the family. This has happened to us. We don't want it to happen to the rest of the family or to the rest of our children. We want to improve our health. Cover costs of time off work to care for children, and 11% to take that child on a bucket list holiday, or the things that they wish to do to cheer them up or to give them what they can whilst they can. Award winning, I've already been through that. I don't have time to show you this claim story slide here, but it's basically on our website. You can go and see the claim stories. It is our claims professionals telling stories alongside the claimant, so you can see how it all works. Our claims professionals are excellent, massive industry experience. We will deal with the claimant how they wish to be dealt with, whether that's phone, digital, paper, however they wish to be dealt with. We will deal with them in that way. The person they initially contact is the person that continues to manage and own that claim and be their point of contact, building empathy, building a relationship, which is incredibly important. We have a claims customer satisfaction score of 9.9 out of 10. Doesn't get much better than that. This is a great story. We paid a claim within a day. This is on a critical illness claim. 49-year-old policy was recently diagnosed with terminal cancer. We agreed the critical claim within a few hours of receiving the call and paid the funds that very same day. Customer was overwhelmed, grateful for our swift and fuss-free service at a very difficult time. But how did we do that? We did that by talking to the cancer nurse. The cancer nurse provided us with all the information we needed, and we were able to pay the claim straight away. We've got our health and wellbeing benefits. All of these are instant access, no increase on cost, no extra cost. All pre-existing conditions are covered, and they are covered for the policyholder's partner and for the children as well in a simple one-app process. So today at 8 o'clock tonight, we will be launching significant, meaningful, and that's a key word for us with these changes, meaningful. We wanted to make sure that the changes we were making to our CI proposition actually added value to the customer and were meaningful and would make a meaningful difference to be claimed against. So these changes we made tonight at 8 o'clock. So I'm going to give you a brief view of what is going to change. I can't give you the detail because we're still not there, but we will be, and this is unique in the industry, we will be offering top-up payments up to the age of 60. Nobody else in the industry offers it up to the age of 60. This is top-up payments up to £200,000 or the sum assured, whichever is the lower. So if the customer's covered for £100,000, we will give them a further £100,000, £200,000 on claim. £200,000 if the policy was the sum assured of £200,000, we would give them a further £200,000. That's £400,000 they would receive. If it's above 200,000, say £400,000, they would get £200,000, £600,000 top-up payment. These are on the illnesses that have further costs past the event. Improvement to your home, mobility aids, that sort of stuff, where that's a genuine, meaningful need for the customer. We have added massive amounts of our definitions that need surgery or treatment. All of the ones that need surgery and treatment have added the NHS waiting list advance payments. So if you're an NHS waiting list, we will advance the payment. We don't have to wait for the surgery to be able to claim. That's a significant help to customers when we've got 6.4 million people on NHS waiting lists and an average waiting time of 18 weeks for surgery. Pregnancy complications. So both for male and female policies. Male policy sounds strange. So on a male policy, if their partner had pregnancy complications, then we will pay out. Enhanced critical illness definitions. So across the board, we've simplified and improved definitions massively. So huge change tonight, which will take us right to the very top of CI Expert and Protection Guru Pro comparisons. So you have access to us for your protection support team. You can equally contact me, and that's the contact team for everything you want to do with HSBC. HSBC Life. That's a summary of our proposition that I've been through, and I've bang on the nose, hit the heart, and that's my contact details. Thank you very much for your time.
Thanks very much, Mark. That was a really good presentation, really sort of thorough, covered a lot of details. Yeah, some big numbers there right off the gates, weren't there? £4.85 billion paid out by the life insurance industry in 2023. Sorry, but paid out, yeah, via the whole industry, of which 3.47 was life and 1.2 billion. I mean, that's a lot of money going back into the economy, helping families pay off mortgages, clear debts, you know, try and pick up the pieces from the challenges and the losses that they've had. Yes, some really good information. You know, for me, one of the key sort of takeouts was just positioning questions differently. You know, you don't have any of the following. It's certain, you know, I've been involved in meetings. I've heard brokers sort of use questioning along that vein. It does instantly sort of, you know, get people to maybe sort of not intentionally, but sort of maybe keep back information, and that can potentially sort of stop future claims. We do obviously need to disclose everything. A sherry at Christmas isn't a good answer to give, is it? From some of those examples that you've given. We have had a question from Caroline. Of course, if you've got any questions, do pop them in. Caroline's question is, do you work with small firms for protection? So it's probably on the sort of distribution side. Do you allow anyone onto panel? What's your stance on that? Okay,
that question, I know where that question's come from, is that the mortgage side are very have a limited amount of agencies each year, and so we have no such restrictions. If you want to do business with HSBC Life, just send me an email, send an email through TMA, and we will set you up with an agency. The only way you can apply to us is via the portal. You have to go via whichever protection portal you're using. But as long as you've got an agency, you'll be able to sign in and progress that. So we do not restrict agencies for anyone.
Okay. Caroline, yeah, just to follow up on that question, if you reach out to our broker support team, if you're using TMA for your protection, our support team can go about setting that agency up and reaching out to Mark and his wider team. There are no other questions. We will, of course, share all of today's slides and the video of the webinar in all of the usual places on our website, on YouTube as well, if you follow us on our YouTube channel. But that draws a close to today. Thank you very much, everyone, for attending. That now concludes our webinar. Thanks very much to all of our hosts, our presenters, and thanks very much.